Good morning, ladies and gentlemen. Welcome to What and Where to Invest 2022. The show must go on. Whilst uncertainties and disruptions may still linger in the world, at FSM1.com, we believe that investing is for the long term. It's not about timing the market, it's about time in the market that investors should pay attention to. In order to help you invest globally and profitably, we have an exciting and insightful lineup of presentations today, featuring ideas and sectors that will be beneficial for your portfolios. In addition to these presentations, we've also lined up some exciting activities which you can take part in throughout the day. Now, show your hand and try your luck in our lucky draw. 8 lucky showgoers will each walk away with a $100 FSM1 cash account credits. We've also got 3 grand prize winners who will receive a $1,000 FSM1 cash account credits each. You can also gain more chances to win the lucky draw by attending the event on both days, visiting sponsor pages, joining our daily quiz, and sharing the event via social media. Each time you do those things, you add to your tally of chances. But do ensure you always use the same ID and email address when logging in. You can also show off your knowledge and participate in the daily quiz. 6 winners each day will walk away with a $100 cash account credits each. Do take note of what is shared throughout the event, as these will help you in answering the questions. But on top of that, of course, by remembering what was shared, it will be useful for your portfolio. All prizes for these activities have been sponsored by our partners, and we'd like to take this opportunity to thank CSOP Asset Management, East Spring Investments and Nickel Asset Management, BlackRock, Franklin Templeton, JP Morgan, UOB Asset Management, Allianz Global Investors, BNY Mellon Investment Management, Neuberger Berman, and Schroders for making this event possible. Now, as we gear up for the start of the sessions today, let's kick things off with a poll. To participate in the poll, firstly, click on Agenda and Activities on the menu on the left-hand side. Under the Agenda, look for poll number 1. Then simply click Join Poll button. The poll window will be displayed on the right. If everyone is ready, let's see what questions we have for today. The poll is a game of Never Have I Ever. If you're ready, question number 1. Never have I ever invested in these markets: China, Singapore, US and Europe, emerging markets. For some of these questions, you may have noticed you have more than one valid answer. In these cases, simply pick the one you feel is most relevant. I repeat, simply pick the one you feel is most relevant. Which is your answer? Let's check out the results. While it seems we have 52.94% choosing emerging markets, China is a choice as well at 37.25%. It seems Singapore, US or Europe is one of the more popular markets, with only 3.92% choosing Singapore and 5.88% choosing US and Europe. Question number 2. Never have I ever invested in these asset classes. Options are unit trusts, bonds, stocks, ETFs, managed portfolios and robo-portfolios. Last option, none. I'm new to investing. I'm curious about the options you have chosen. Once again, we have many options, and if you have more than one valid answer, simply choose the one you feel is most relevant. Never have I ever invested in these asset classes. Let's take a look at the option with the biggest vote, 46.15% choosing managed portfolios and robo portfolios. It seems that it's a pretty new option, so it's quite fresh in the market. Unit trusts and bonds have also taken a good percentage, and the one with the lowest is actually none. I'm new to investing. Alright, let's take a look at question number 3. Never have I ever invested in these product types. We've got Forex, cryptocurrencies, options, futures, and CFDs, sustainable and ESG products, real estate and physical property, investment-linked insurance products, ILPs. Never have I ever invested in these product types. We've got quite a lot of options for you today. Make sure to pick the one you feel is the most relevant. Wow, 48% have chosen cryptocurrencies. And Forex and CFDs have also taken a good percentage of our votes. And ILPs seemingly are the ones that are the most popular in our market among our audience today. Wow, this is a pretty good spread, and real estate, physical property, sustainable ESG products are all quite common among you. Question number 4. Never have I ever invested based on gut feeling, social media posts, unverified news and rumors, analysts' recommendations, and the last option, tips given by family or friends. This is one of our most fun questions today. I'm quite curious to see your answers. Once again, choose the most relevant. Never have I invested based on unverified news or rumors. Well, I see we have a lot of very smart and well-versed investors among our audience today. 52.25% of you have chosen unverified news or rumors. And let's take a look at the option with the least votes chosen, analyst recommendations. Following up in second place, oh wow, gut feeling. Thank you all for participating. That is the end of our poll for today. Thank you for participating once again. Now, let's begin our very first segment of the day, top markets and macro themes to take the crown in 2022 by inviting a few special guests to our show. But before that, have you watched any memorable movies or TV shows in 2021 that inspired the way you invest in 2021? Let's find out from our panelists. With us today, we have Rusmin Ang, the co-founder of The Fifth Person, Catherine Chua from the investment advisory team at FSM1.com, and Jean-Paul Wong, general manager at FSM1.com, as they discuss investment lessons we can learn from the movies and TVs in 2021.
Good morning, everybody. Thanks so much for joining us at What and Where to Invest in 2022. So my name is JP from FSM1.com, and I have Catherine from our investment advisory team, as well as Rusmin from The Fifth Person. Hello. Very happy to have all of you join us today, early morning, to listen to the views from our different panelists and investment analysts and fund managers throughout today. I'm very happy to have Rusmin and Kat as well to talk about the investment lessons we can learn from movies and TV shows. Maybe when we talk about movies and TV shows, we don't really think about investment lessons that we could take away from. But I believe my panelists would have very interesting insights to share with you today. So I wanted to just go through the first question. So have your investment decisions been inspired by any popular movies, TV shows, ads, or books, and any quotes that have really stood out and stuck with you, throughout all these years of investing? So I'll start with Rosmin.
Yeah, sure. Good morning, everyone. Okay, so I think the one show that I would like to bring up probably this show called Squid Game, right? So I think Squid Game has been very popular over the last couple of months. It's been all-time high for Netflix in terms of viewership, and that was a game where I think based on some Korean childhood games, right? And the players were supposed to play the games, and if they failed the game, they will get eliminated, right? So, and I still remember the show. Okay, if you have not watched Squid Game, obviously there's going to be a major spoiler ahead, right? Because I have to review some of the games, right? Yes. In order for me to share with you some of the learning lesson. And the first game was actually this game on red light, green light. You have this gigantic robot, the lady.
Yeah, and slightly scary looking one. Huh?
Yeah, and she start to sing, right? So basically the game is very simple, right? The players in the game have to cross the finish line by a certain timing, right? But they have to start whenever there's a green light. Okay, they move, right? When the song stop, they have to stop, right? So that's red light, right? So when the game started, there was this guy rushing over, right? And then all of a sudden he died because he didn't follow the rules, right? And he got shot, okay? And after that, when then the song started to sing again, and the players started to move, but this time now quite a number of them followed the rules, but quite a bunch of them didn't follow the rules, right? And in the end, quite a lot of them actually got shot, okay? And when you start to see people getting shot and killed on that spot, at the game itself, okay, so a lot of people were panicked. Okay, and they were all trying to rush to the exit. And at the time when these people were not following the rule, they all get shot and they all in the end get killed. Okay, so why this game has a lesson for us in investing, okay, is mainly because how you play the game is how you play or invest in the stock market. Okay, so a lot of time when you play the game under a very stressful environment, right, your behavior, your emotion, all will come up. Okay, and this is the same thing, right? Investing is a very emotional journey for a lot of people. So at the time, you can see that people were panicking, and this is exactly happened in the stock market crash. Okay, so I still remember last year, 2020, or 2 years ago. All right, yes. Now we're in the new year, and when the market crashed, you can see that there was a big dip, right? And that was the fastest correction I ever experienced, right? And it was within, I think, 1 month, the market has corrected in the US market about 30%. It was a big dip, okay, and a lot of people got scared. And I have some customers actually coming to me saying that, what to buy, okay? But for our customers, it's different because we have trained them, whenever there's a crisis, you need to buy, okay? So I was speaking to Katerina, I think yesterday, and I was sharing with you that she got a lot of calls from your customers asking her which stocks to sell or which fund to sell, okay, at the time during the meltdown. Okay, yeah. So it's quite common to see people panicking whenever there's a crash. Okay, so that's why it's very important, in investing, you need to have a rules, right? So same thing in the games that they play in the Squid Game. You need to have a rules to follow very strictly. So if you are someone who, figure out that you want to do long-term investing over a long run, okay, you don't panic in this kind of situation, right? Whenever there's a big sell down, you got to stick through your principle. You don't move, right? Otherwise, you're going to get killed. Okay, because when people move, when they're not supposed to move, in the stock market, basically they sell. When they're not supposed to sell, that's where they buy high, sell low. Yeah, so I think that is something that the Squid Game is a very interesting game I shared because it reflects a lot of our behaviors, right? Although we don't play the game, but you get to see a lot of how people behave. And that's actually very similar, a lot of parallel that you can draw in between investing and also in the game itself.
Yeah. Seems like you're a huge fan, Rusmin, of the
just me,
Squid
I
Game.
think a lot of people.
I don't know whether, Katrin, you also got bitten by the Squid Game bug as well last year.
Yes, actually, I also did watch the show, and I mean, apart from the game itself, I do think that there's a lot of parallels in terms of the personal finance perspective, because like what actually draw most of, in fact, all of the contestants into the game is because like how they have actually poorly managed their finance. So like for instance, the protagonist, he actually how do you say hooked on gambling, and then like he borrowed a lot of money, and then he just like trying to bet on a single, like a horse, or like those I would think it's something similar to investing as well. Sometimes people just want to go for the quick buck and want to make like get rich quick, so they'll just try to put all their eggs into one basket and hope that this kind of situation would turn around in their favor, and you know they can get rich quick. Which I do think is very dangerous, especially and also the parallel that the protagonist, the mother went into the hospital because of some diabetic problems, and they had to actually go for surgery. And I thought it was very upsetting at one point that the parents actually, as in the mom, actually could not go for the surgery because he said that they had terminated all those insurance or those health policies. So I do think that it's like a very sad tone, and that was what actually urged him to go into the game and play all these. Even the protagonist's childhood friend, he also sold his mom's store and the home to leverage up on his dad and to play on all these very high-risk instruments, which I do think that there's really a lot of high-risk instruments, especially you're talking about speculative stocks and all. So I do think all
crypto and meme stocks.
Yes, exactly. So I think it's very dangerous that, I mean, should we invest a very huge chunk of our investment portfolio in these kind of uncertain stocks? I mean, yes, you may get rich quick, but at what expense? Like, you could lose everything the next day. And I mean, in real life, there's no Squid Game for us to play, so it's really a very high risk option for all of us.
So I think I'm the only one who haven't watched the show.
Spoiler.
So a lot of spoiler alerts here for me, but I'll probably catch it after the event. So I wanted to just catch on a couple of points you shared. I think first, the psychology, I think in investing. I think I remember reading a couple of phrases, or even in the Intelligent Investor by Benjamin Graham, that actually I think the chief problem we all have as investors is actually our mindset. It's not maybe the fact that the interest rates are going to shoot up faster this year in March instead of June. It's not maybe because inflation is going to rise up by 100 basis points more than expected, or whether the regulators are going to crack down harder, let's say on Chinese tech and so on. It's really what we do. And I think behind all that is what's the plan? Or why are we investing? I think if we know why we are investing, a lot of things just become clearer in terms of what we should do, like the few steps. And maybe you have your red and green lines in terms of what you shouldn't do or can do or cross, right? And so on. So that's how I think, that's one of the things I think I took away from many years of investing and also from last year. So I'll move on to last year. So last year, just to go back to how the markets have performed, the US just continues to do so well. Just keep getting or reaching record highs, would be the S&P 500, Dow Jones, or even your NASDAQ. And US market here, as you can see, one of the top performing behind Taiwan. But of course, Singapore, our home market, did fairly well too last year. Despite all the challenges that we have gone through the last 2 years because of the pandemic, and also the restrictions, and being a very open economy, obviously that has an impact on us. But I think low base from 2020, 2021, then it got better in terms of earnings outlook for a lot of the Singapore companies. The interesting stuff here as well, it's I think China and Hong Kong to some extent are very related. So those performed badly. I think the surprise there was really the Chinese authorities coming in to crack down on various sectors, really, and that I think surprised quite a number of investors in terms of the extent and impact. And digital economy as well, I think our team of analysts at iFast, we were also cautioning a bit. We like the team a lot and we still have exposure to it in our managed portfolios, but we felt like the valuations have gone up quite a bit. And I think last year it's actually down, despite all this positive news about digital economy-driven kind of stocks, right? But I think because they run up a lot in 2020 especially, so 2021 there was a bit of a correction. So that's a bit of a backdrop. So I just wanted to ask the two of you, for you, what was the Oscar-worthy moment from the markets last year, and why was it so impactful for you? Yeah, Kat?
Okay, so yeah, I'll start first. I think like the Oscar-worthy moment, there was like it's about the China tech regulatory concern. Like after its peak in February, it just went downhill even till today. I think year to date it's more than 40%. I mean, since the peak, it has been more than 40% losses in this segment. So I do think that it's really very Oscar-worthy because it's something that nobody had expected it to happen. And also the later part of 2021 is also within the Chinese equity space, but more of the property developers, like all those highly leveraged property developers. I would think it's like very drama-like situation because it's like really week after week we do hear negative news from various different companies. So like even I think it's Oscar-worthy because like it's something that we have never seen. It's unprecedented. Like the yields for all these high yield bonds, even for like a BBB bonds, typically they will raise that at like about 2 to 3%, but we are looking at BBB bonds going at like 9 to 10%. It's really unheard of, and I really thought that like it could really be the end of the world. I mean, China is so strong on its developers, property development, real estate segment. Yeah, so I do think this is really very Oscar-worthy. Yeah,
really like one of the highlights, and like what Rusmi was saying, probably quite a number of clients contacted you as well. Over concerns on China, to some extent Asian high yield, China high yield bonds, right? So Rusmin, how about you? What's your Oscar-worthy moment?
My Oscar-worthy moments will probably be the pace of how the stock market actually had changed over the years, right? So I think the full cycle of the stock market before the pandemic, it was usually the 10-year cycle. And the last one, the previous one, before the Lehman Brothers collapse, we actually saw that the cycle started to have a bull run in 2003. Right? All the way to 2007, it peaked there, and then the market started to correct down in 0809. That was where the bottom is, right? And then it started to recover, I think fully recover only by 2012. So it took almost 10 years for the full cycle. But last couple of years, it's quite interesting. We saw the whole full cycle in that short span of 2 years. Okay, so that was a moment where, for those who started to learn investing, obviously that is a good thing because you don't need to wait that long to see the full cycle. Now it happens just within that 2 years. Okay, and what I also realized that another Oscar moment was that there's a big shift in terms of how information is actually being delivered. In the past, it used to be broker, right, that can move the market, or some stock manipulator that they work each other. You call it chengke, right? And also some media, newspaper, sometimes you write certain company that share price will move up. But nowadays, it's no longer moved by all those stuff. It's moved by social media. You have Twitters, you have your TikTok, people recommending stocks to buy, cryptos, and then a lot of meme stocks. Okay, those are what I call it as meme stock. And that actually has shifted. So the way we invest, and we actually now being exposed to a lot of noises in the market. So I just want to cautious, all of you here is that when you start to open your YouTube or even Twitter or even some of the TikTok, you start to follow some maybe financial influencer, right? And you start to get influenced by them subconsciously, right? Whether you like it or not, when you hear to their pitch, you will be influenced by their idea. Okay, so it's important to choose the right people to follow. Okay, that's important. And second is that if you choose the wrong people to follow, you're going to get flooded with a lot of noises. Okay, so when you're flooded with a lot of noises, at the end of the day, you will get very confused. And that's why for me, I do a lot of fundamental investing, long-term investing. So I feel that there are a lot of more noises out there right now versus 10 years ago, before the smartphone became very popular. Yeah. So that has been a dramatic shift in terms of how we actually make decisions today. Okay. So you need to be very aware of that. Yeah.
Yeah, I agree with you, Rusmin. The perspectives have changed so much in just a short period of time.
Yes.
And if you imagine if you started investing like you were saying in the last 1 to 2 years, it just seems so easy to make quick money, right? Yeah, it's like what crisis? I mean, they probably like say, "What? You're not buying crypto? Then you're a boomer, right?" So things like that. And I also would like to, of course, caution that. Just now there was a poll, right? Never have I invested in cryptos. So 50%, 48%, close to half. So actually quite a bit of viewers and investors are actually have started taking their first step in the crypto market. And I think to me it's a bit of a red flag, I think, if investors are just focusing on, let's say, crypto to plan out their investing plan. So it's back to my first point just now about having that plan and why we have the plan, because it's going to be super volatile because it's not based on fundamental factors of investing.
Yes.
I think when we buy a stock, it's really based on fundamentals as to whether it's attractive to, let's say, buy into this company because of its earnings potential in the next 1 to 2 years. Because of the management team, we think it's solid. They are not smoking us, we think, and things like that. So there are concrete fundamental factors that drive us to think, okay, it's cheap to go in even after it has crashed, let's say 30%. But for crypto, after it has crashed 30%, some people are saying, oh, buy on the dips, but based on what factors? So it's based on just, it's 30% cheaper, and that's it, essentially. So that's a bit of a concern, I think, as well, in terms of the trends. And I see some of my friends already buying into it, so they're probably part of the, almost half of the
Now when
audience.
now when you go social gathering, NFT cryptos are the topic now.
Yes.
Yeah, that's right. So and it just gets a very blurry as well. So the conversation on metaverse and NFTs and your cryptos just gets all lumped together. But I think there are very different considerations. Even like blockchain, even if it's a solid technology. Today and in the future, it doesn't mean that crypto will benefit because of blockchain technology, for example. So I think we need to be clear on the separation of these different concepts. Yeah. And it also brings me to another point. I didn't watch all the Squid Game shows, but I was just trying to think what movie or what line from a movie that I remember. And I remember this line from Forrest Gump. Yeah, I think towards the end of the show, when I watched it the first time, I was quite young. So the movie came out in 94, by the way, so 1994. So I remember he was like looking at a letter, so it was sent from the stock company, and there was that little colorful logo sign. So he said, apparently he heard that he has made a lot of money because there was some money that was invested for him in that company that he calls a fruit company. So make a guess, what's the fruit company? With a logo sign.
I have no idea.
So it's Apple.
Apple.
Yes.
Okay.
So imagine he without him knowing, he actually bought into, someone bought for him. And obviously, if we fast forward to, let's say today, that investment, I think, I was trying to check on Google, I think it was like equivalent to about 3% back then in Apple. So that would be worth, I don't know, tens of billions of dollars. Today. And the interesting thing about that, of course, is also that I think Forrest Gump was saying, I made a lot of money, one worry less. And I think that is something that is very true. Money should be a way for us to achieve our objectives that we want. So whether it's for me to want to have retirement money, passive income, whether my kids have their education funds in place. And to me, if I can have a solid plan, then it's one worry less for me. Yeah. Okay. So I got to rush. I think we talked quite a bit and quite long. We can go on for quite long, I guess. So going to 2022, just maybe what's your favorite ideas or investments? So I'll start with Rosmin.
I think I'm very aggressive in Chinese market because the valuation has actually been very attractive, especially the Chinese tech scene. I think the valuation is actually at all-time low. If you compare to the last COVID 2020 low, it's actually way lower than that. Okay, so Chinese tech space is an area where I think you guys probably want want to look at. Although it has been politicized in the West, or where a lot of Americans actually view Chinese stock as uninvestable because it's run by communists, a bunch of communists, right? So I think that's not true, because China is actually very similar to Singapore, so we can totally understand how China is actually being run, and and a lot of quality companies are actually being punished and trade at a historical low valuation. Okay, so that is the area where I think it should be aggressive, but I'm more conservative toward US market. Like you said, US is one of the best performers last year, but then you don't want to go into that area, because in the next couple of years, that may not be the best market to be in. Yeah.
Sure.
Yeah.
Kat,
Actually,
how about you?
riding on Rusmi's point, I was actually also going to talk about the same segment. For a tactical exposure, definitely Chinese tech stock looks very attractive. And I want to bring up a quote by Warren Buffett. He always says that be fearful when everyone is greedy, and be greedy when everyone is fearful. So right now at this valuation, you look at all the shares, the prices where they are trading at, even big names, they are even lower than 2018, like pre-US China trade war time. So I mean, if you are looking at companies today, the revenues are still growing, their fundamentals are still solid, and we do think that these kind of regulatory pressures, probably they are not meant to stifle the growth of the companies, and I would think this would benefit the companies in the long run. So if investors had not yet to be invested, I do think it's a very opportune time to look into this, and it's definitely one of our house call for 2022. Yeah, and also if those who had already invested, say last year, or just right before the peak, I do think that if it's not a very huge chunk of your portfolio yet, you may consider to dollar cost average in as well, because these are a space that we like. We still like the companies. Yeah.
Yeah, thanks for all these ideas. I agree with them as well. And I was talking about the plan. So I think plan, one way I do it is have a core and a supplementary. Core is all your big investments, solid foundation ideas. So within that space, I would say I'll go for Asia ex-Japan equities. Of course, a lot of it is in China. So why? Well, it's really because of valuation point of view. It's bashed. So it's fairly cheap compared to a lot of regions. I think Europe also looks good in that core portfolio. Supplementary, try to keep it smaller, 10-20% of the overall size, because these are your more tactical, a bit more high risk kind of volatile ideas. So I'd say within that space, Chinese tech, yes, and I think Chinese semicons as well, because of all the catalysts and support from the government to push their own homegrown sectors, including semicons. So those would be my key ideas. So just to wrap up, so if you're going to be a character from a TV movie or a show, which one would you be, Rusmin?
My actual character that I admire is actually Charlie Munger, not so much on the show, right? So I think he's a guy that is brilliant. He writes so much, and yet he's still so humble, down to earth. Yeah. He has never made a mistake before, so I couldn't learn from him. But he shared a lot of psychological stuff when it comes to investing, which is a lot of people don't touch. Psychology is a big part of your investment that actually influences on how you make decisions day in, day out.
Yeah, totally agree. It's all about the mindset and how you stay calm when people are panicking around you, right? Like you were saying in the first example for Squid Game. How about you, Kat?
For me, I would prefer to be the character in one of the shows on Disney, Loki. The guy who is they call it He Who Remains. So basically, he guards the sacred timeline, and he has a team of timekeepers that will prevent any deviation to create a multiverse. Yeah. So basically, this dude, why I like him is because he knows everything. So I would think in this, in a real life situation, he will definitely be the Mr. Know-it-all, and of course, he will never ever make a mistake as well. Maybe like Charlie Munger.
Yeah. And I'll wrap up by saying that Charlie Munger is, I think, one of the related grandfather of value investing, Benjamin Graham. If you haven't read that book, Intelligent Investor, it's a great start to look into fundamental investing. That's really going to help you throughout your investing journey, I think, for many years or decades. So with that, that brings the panel discussion, the very first one, why and where, to a close. We still have a lot of programs. Colin is coming up next on his best market ideas for 2022. So once again, thank you to the audience for being with us, and to Rosmin and Kat so much. Thank you so much for all your ideas and sharings. So thank you.
Thank you, Rusmin, Catherine, and John Paul. And John Paul is right. Our next speaker is Colin Low, Assistant Manager, Macro Research from IFA Singapore. Colin will be sharing views on the current market narrative, top macro themes in 2022, and what this means for your asset allocations for 2022. So, let's welcome Colin.
Hi everyone, welcome to What and Where to Invest 2022. I'm Colin, Assistant Manager of IFA's Macro Research Team. And today in this session, I'll be sharing the top markets and macro themes for the year. I'll begin by sharing our views across asset classes, in particular global equities and fixed income. And next, I'll talk about one of the biggest macro themes of last year, which is inflation and the interest rate outlook. Subsequently, I'll share our views on the major developed and equity and emerging equity markets before concluding with our views on the fixed income universe, and in particular, the IG bonds as well as the high yield bonds. So, let us start to take a look at the global equity markets. So for global equities, we expect fundamentals to remain supportive and will be a pivotal factor in driving equity upside this year. We expect the global economic recovery to continue, fueled by more reopenings, particularly in Asia. While the Omicron variant acts as a growth risk, global COVID death rates have fortunately remained low and vaccination rates are climbing steadily. Therefore, in our base case, we do not see Omicron as a severe growth risk holding back the recovery. And looking ahead, we expect global GDP to continue its growth at 4.4% this year. Similarly, global earnings recovery should also continue its run. As shown on the chart by the right, we expect global earnings to grow by 7% this year. While there will be some EPS normalization moving ahead, growth rates should remain positive this year as well as the next. Overall, fundamentals should remain robust and continue to lend support to global equities. Contrary to equities, 2021 was not a good year for fixed income. As shown on the chart, bonds had a pretty lackluster run last year. Unfortunately, it is likely that this year may remain challenging to fixed income, and we view the asset class to be relatively less attractive as, first, many segments are now offering limited value, with credit spreads trading extremely tight relative to history. Second, with yields relatively low versus history and credit spreads having little room for compression, we expect moderate upside for most fixed income segments this year. Third, the macro backdrop this year remains challenging for fixed income. With the Fed likely to hike interest rate in 2022, the asset class remains vulnerable to price declines. Also, elevated inflation levels are now eating to real return for these bonds. Therefore, taking all these factors into consideration, we expect equities to outperform fixed income this year and prefer to stay overweight the former. So now let us talk about inflation, which has been one of the major macro themes for the year. So over the past 2 quarters, it has become increasingly obvious that US inflation is taking longer than expected to dissipate. If you look at the inflation data, US monthly CPI has remained above 5% since May last year. Furthermore, data are now showing higher prices across inflation components such as wages and shelter, which are sticky in nature and tend to result in more stubborn inflation. And moving ahead, our team expects inflation to remain elevated in 2022 as well as 2023. And in line with that, we also expect the Fed to kickstart its rate hike cycle for this year. Investors should therefore stay away from longer duration fixed income assets. And the other thing to note here is that higher prices are now starting to have a material impact. And as shown on the chart by the left, the US PPI data has surged drastically in 2021. In fact, the CPI to PPI spreads are near the lowest level since 1974. And this implies that businesses are having trouble passing along the entirety of the higher costs to consumers. And as a result of this, it is very likely that we might see some profit headwinds for US businesses this year. And this is something that we are watching for closely. So now let us move on to DM equities, starting with the US. So US equities have had a good run last year as the easy monetary backdrop, robust economic recovery, as well as a strong earnings growth fueled US equities outperformance. However, equity valuation remains a key focus. Valuation metrics are currently very stretched and has priced in many positives, leaving little room for risk. For instance, the S&P 500 index is currently trading at around 30% premium to its historical average in terms of forward PE ratio. Even compared to other DMs such as Europe and Japan, US equities are trading at a larger than average premium. And another thing to note here is that while valuations remains elevated, earnings growth has slightly peaked in 2021. We expect earnings growth to normalize, coming in at around 8 to 10% for both this year as well as the next. Consensus remains optimistic on US earnings, but we, however, remain vigilant and looking for signs of earning weakness. And beneath the hood, if you look at the US corporates' earnings data, we can find that US corporates are now facing rising cost pressures given higher material costs as well as higher wages. And these have begun to show up on the various cost metrics. While the impact on profits at the current moment remains slightly mild, we expect the earnings itself to come under some pressure later on in the year as the profit compression might build when the cost builds as well as when economic growth moderates. Further, as shown on the chart by the left, the positive earnings revision for many major sectors such as your IT, consumer discretionary, as well as comm services have also stalled last quarter. And on a bottom-up basis, the magnitude and number of companies beating earning estimates are also declining as well. At the current valuation level, we therefore see rising likelihood of valuation contraction given a potential profit compression and earnings disappointment later in the year. Overall, based on our forecast, we expect low upside potential from US equity by end 2023, and instead we see better option elsewhere, especially in other DMs, and recommend to underweight US equities moving ahead. So now let us shift our focus from US equities to European equities. And despite the challenging month in December due to Omicron fears, we believe European equities remain an attractive value seeker play on the global recovery given three core reasons. First, the index itself has a globalized revenue exposure where international revenue makes up almost 60% of the index. Two, the index also possesses a pro-cyclical tilt. And three, the ECB has relatively more dovish policies. And this means that an ongoing global economic recovery, which is our base case, should be very supportive of European equity performance. Furthermore, if you look at corporate earnings, which themselves are very leveraged to the global economy, are expected to grow above long-term trend over the next few years. To put things into context, EPS for European equities grew at 10-year CAGR rate of 4% before COVID hits. And looking ahead, we expect EPS growth over the next few years to double at around 7 to 8%, as illustrated on the chart by the right. Additionally, European equities are now trading at attractive valuations, which is decent on a historical basis, but cheap on a relative basis. Firstly, European equities on aggregate are trading below our target fair PE of 16.5 times. And secondly, European equities are trading at an increasing discount to US equities, denoted by the declining relative forward PE ratio shown on the chart by the left. What made this interesting is that performances for both equities were roughly the same during this period, as shown by the flattish price ratio. And a quick look at relative valuation shows that European equities are in fact trading at a 27% discount to its US counterpart, which is significantly larger than the historical average of 16%. And taken all together, this implies strong relative value coming from European equities. Therefore, we believe valuation expansion in conjunction with decent earnings growth should drive a fairly strong upside potential of around 13% by end 2023. That said, we do not expect a smooth sailing journey ahead, and we are watching for possible near-term growth risks, as well as we expect higher price volatility given the surge in Omicron cases. Next, let us move on to one of the top markets we have this year, which is Hong Kong equities. And if you look at 2021, no doubt it wasn't a good year for Hong Kong equities. But aside from the poor market performance, we note that fundamentals themselves have not materially worsened. And a quick look at corporate earnings show that EPS has been revised upwards in 2021 and growth estimates remain resilient despite the market turbulence. Furthermore, our team sees double-digit earnings growth for this year and expect the strong growth to be fueled by the Chinese tech giants as well as the Chinese financials. As shown on the table by the top, consensus expects the major Chinese tech giants to generate considerable earnings growth this year as profitability remains firm despite the ongoing regulation. Furthermore, if earnings growth can meet market expectations, we expect valuations for this company to re-rate higher, thereby driving the index equity performance. For Chinese financials, it is evident that the sector itself is receiving more support. We expect a healthy rebound in loan growth this year and further credit stabilizing policy by the Chinese government. This market as well as policy-driven factors should altogether bolster the bank's profitability. And another major factor why we like the Hong Kong equities is the ongoing reform for the Hang Seng Index. So with this reform, effectively the number of its components will likely increase to 80 by mid-2022, and the proportion of new economic stocks in the HSI will certainly climb. And essentially, the inclusion of more high-growth companies should also greatly boost the index earnings growth, as well as the re-rating potential over the longer run. While one may argue that there is more exposure to regulatory risk from this reform, we believe that these headwinds are likely shorter in nature and much have been baked in equity prices. Ultimately, we expect these headwinds, which are longer term in tailwinds, which are longer term in nature, to outweigh the headwinds. And that said, we believe Hong Kong equities demonstrate a high growth, low valuation characteristic, which we favor, and we therefore expect an upside potential of more than 50% by end 2023. So now let's move to EM equities and starting with China. And many of you may already know that 2021 was a challenging year for China equities, where the region's performance was severely held back by a mix of regulatory risks as well as economic growth concern. And that said, we believe things may change this year. While economic growth has indeed been slowing in China, the good news is that policy direction is now decisively in easing mode. Over the past quarter, we have seen multiple easing measures implemented by the People's Bank of China and also policies by the government to stabilize the housing sector. We are therefore closely watching for the China's credit impulse, which is shown on the chart by the left. The 12-month net change in credit impulse, which is often a leading indicator of economic momentum and earnings growth, is now showing signs of reversing as more easy policies kick in. Another major positive factor is that base effect should also be turning easier and supportive for economic data in a couple months' time. Additionally, based on our observation, the tightening of regulation across the different industries has also moderated lately. While regulatory pressure, in our view, is likely to remain this year, the good news is that it will likely moderate given China's slowing growth. And therefore, in 2022, we expect regulatory headwinds to ease and economic growth to stabilize, which may signal a potential upwards revision in GDP and earning estimates, and therefore lending support to China equities. We think overall China equities have priced in a lot of pessimism due to the regulatory headwinds, and this is reflected by the forward PE ratio, which has fallen by more than 5 points from a high of 19 times since February last year, captured on the chart by the left. And what made this more interesting is that the China equities are expected to generate strong double-digit earnings growth of 14 to 18% in 2022 and 2023, which makes valuation even more attractive on a forward basis. And last but not least, based on our projection, China equities boast an attractive upside potential of around 40% by end 2023, driven by a strong mix of earnings growth as well as valuation expansion. So taking all these factors into consideration, we believe 2022 should be a better year for China equities, which are looking more attractive. And now let's move on to India. And India itself was a top performing market last year. If you were to look at the macro data as well as the earnings data for Indian equities, they have both rebounded relatively strong. And the rebound itself took place mostly in the second half of this year, where the COVID situation has greatly improved. As the domestic retail investors turn overwhelmingly optimistic, Indian equities actually rallied fast and hard, and therefore have priced in this positive in valuation, and therefore you can see that valuations have now reached new highs. And despite the brief derating in the previous quarter, most of the valuation metrics are still at an extreme and are also expensive relative to history as well as against EM peers. Take, for example, the forward PE ratio for the Sensex index, which is shown on this chart right here. It is currently trading at around 40% premium over the long-term average. And in our view, this makes Indian equities more vulnerable to valuation contraction, which we think can come from negative catalysts such as a rebound in energy prices, central bank rate hikes, and Omicron growth risks. So at the same time, when we look at the flow data, it suggests that the recent strong performance in Indian equities is arguably tactical in nature as investors shifted their exposure from China equities. So this may also unwind if equity risk builds. And that said, despite all these drawbacks, we do see long-term growth potential in the Indian economy as well as the equity markets, particularly with India's position as a key beneficiary of the global supply chain relocation from China. And all this arises partly due to the ongoing US-China tension and China's shift away from a manufacturing growth model. So broadly, our team sees this as a multi-decade trend that should serve as a structural tailwind for Indian equities. And overall, with the risk-reward for Indian equities fairly balanced, we maintain a neutral rating on Indian equities moving ahead. But we may revisit our stance should valuation turn more reasonable. So moving from equities to fixed income, let us now take a look at investment-grade bonds. So starting with the positive, we expect a continued corporate recovery this year given the supportive macro and policy backdrop. All this should result in stronger corporate balance sheets and improvement in credit metrics for many issuers. Global liquidity itself should remain supportive as well, while the Fed's pace of asset purchase will reduce this year with the probability of it reversing. We still see the asset balance sheet itself remaining much higher than what we've seen pre-COVID. And overall, the higher policy rates, which many of the investors are having concerns about, should likely occur only in the second half of this year. And as such, given those factors, we think that the liquidity backdrop itself should remain supportive for credit for most of the year. And that said, we look at the drawbacks for IG bonds, it is quite obvious. So the drawbacks are that credit spreads are extremely tight. So spreads itself, as shown on the chart right here, are near historical lows for many of the key segments. And in our view, the IG bonds offer limited value. So the other thing to note here is that yields for IG bonds, which are relatively low to begin with, have declined significantly. So this poses many challenges because, number one, rising inflation, which is our base case, reduces the real return for IG bonds. And two, the risk-free rate of the risk-free US Treasuries are now becoming more attractive given the comparable yields, which may result in a reduced demand for IG bonds. So within the IG bond space, our preference lies with the Asian IG bonds. So our preference is anchored, in fact, by three main reasons. Firstly, Asian IG bonds is one of the few investment-grade segments which offer relative value. Yes, the higher spreads itself may imply more credit risk, but over the past few quarters, credit fundamentals for Asian IG has stabilized. So for example, if you look at the Moody's upgrade to downgrade ratio for Asian issuers, you'll find that the ratio has seemingly bottomed out in the third quarter of last year, as more issuers are now seeing credit upgrades relative to downgrades. And second, Asian IG bonds boast a more attractive combination of higher yields as well as a shorter duration. And overall, this implies that the segment itself is more resilient to higher interest rate, as it takes a larger rise in interest rates to offset the yield over a fixed period. And lastly, we see the scope for Asian IG bonds to outperform its peers, given its higher yield and room for spread compression. In particular, the incremental easing of policies in China should lead to spread compression in China IG bonds, which itself is a significant component within the Asian IG bonds. So now let us move on to the high yield bond space. And as I previously highlighted, corporate fundamentals and liquidity backdrop should prove supportive for riskier fixed income segments. Additionally, the rebound in energy prices, the restart in manufacturing activities, as well as the recovery in global consumers have really supported many large risky sectors such as your energy, industrial, and consumers. And therefore, with this development, as well as a more supportive backdrop, we believe that the credit risk for issuers will likely be manageable this year and will not be a key concern for high-yield bonds. Also, as a result of the improving credit fundamentals and the ongoing hunt for yield, we expect demand for higher-yield bonds to remain firm from both a retail as well as an institutional player perspective. And from a technical standpoint, high-yield issuers should be met with favorable demands and strong inflows, which will be supportive for the asset class. However, with the tightening of monetary policy in the US and to some extent globally as well, we do expect more volatility in credit spreads for high-yield bonds as compared to last year. But nonetheless, we do see stronger upside potential for high-yield bonds relative to IG bonds, and thus prefer the former moving ahead. Within the high-yield space, we prefer Asia high-yield bonds. And the primary concern for Asia high-yield bonds is definitely on the Chinese property sector. While we still believe the property sector will still be under pressure this year, and we do not rule out the further defaults. However, based on our estimates, the default risk should be manageable as one, the policy direction in China is decisively in easing mode, and two, there are more policies targeting China property sector. And lastly, key officials, including presidency, are all now in agreement to stabilize the property sector. Furthermore, we believe credit spreads for Asian high-yield bonds, which are around 8 to 9%, have priced in the heightened risk of the Chinese property issuers. And the spread compression in 2022 looks likely based on the macro outlook of Asian markets, as well as the direction of Chinese policy. and also if Asia high yield bonds are able to manage the upcoming bond maturities this year, which many are concerned about, it may also lead to further spread compression. And lastly, Asia high yield bonds also boast one of the highest yield to duration ratio amongst the high yield bond space, which means that prices are now more resilient to interest rate movements. And overall, we think that the risk reward for Asia high yield bonds have certainly become more favorable lately. And moving ahead, we do find that the asset class remains attractive. And our recommendation, of course, for investors is to opt for an active approach when investing in Asian high yield bonds. All right, and with that, I've come to the end of my presentation, and I hope the viewers have some valuable takeaways through today's presentation. And once again, thank you for your time and have a great year ahead.
Thank you, Colin. China equities had a woeful 2021, plagued by drastic regulatory changes, power and production changes, as well as bond defaults. But we believe the market has the potential in 2022 to rise from the ashes of 2021 like a phoenix. To give us more insight, we have with us Danny Tang, fund manager from iFast China, to share about the three sectors we are most positive on in the world's second largest economy, that is China. Also joining us in this discussion is Chloe Halim, equity analyst at iFast Singapore.
Hi everyone, thank you for joining us today. I'm Chloe, an equity analyst from iFast Singapore. With me today is Danny, a fund manager from iFast China. Danny will be sharing more about what's next for China in 2022, as well as three sectors in which they are positive on. Following which, we will have a Q&A segment. So Danny, would you like to start?
Hello, everyone. This is Danny Tam from FS China Research Team. Before I give you our view on what's next for China in 2022, I want to give a brief review on our past views towards China's market during past several years. Because it's important for you to understand what's our view for China in 2022. At the beginning of each year, we will give our pretty straightforward outlook. After over 30% drop of China Asia in 2018, most of investors had very negative feeling towards the market. However, for us, we see a great potential. We state that 50% upside potential in 2 years by the end of 2020 in China, even amidst US-China trade friction. It turns out the market has risen over 30% in 2019 alone. Investors start to doubt if the market will still rise in 2020. Our call still stick to our call at the beginning of 2019. There is still a 20% upside potential in 2020, even after a 30% increase in 2019 already. The result has proved our view. China Asia has become the second best market in 2019 and 2020, if we look at the accumulative return. Time to early 2021, we saw the market sentiment become very hot after 2 years of bull market. We start to ask our investors to calm down and lower the return expectation within next 2 years. We did another 2 years forecast, and we will only have 10% upside by the end of 2020, started from the beginning of 2021. When we announced the forecast, a lot of investors in China didn't believe us because the market was too good in 2019 and 2020. The positive sentiment was still there at the beginning of last year. By the middle of February last year, the market has already risen 10%. But after the Chinese New Year festival of 2021, the market has a huge correction, around 50% drop. By the end of last year, the market had a negative return of 5.2 for the whole year. So now, what's the forecast for? Is the forecast of a cumulative return 10% in year 2021 and year 2022 still hold? What's the next for China in 2021? Before I give the answer, I want to give a little bit information of how we did the projection. Our methodology is fundamental analysis. There is a ratio called PE, which I believe most of our investors knows it. It is a ratio that measures a company or sector's current share price relative to its earning, which equals to a price divided by earning. After we do a little bit modification to this equation, we get the price equals to the earning multiplied by PE, which means if the price market wants to go up, it is either has good earning or its valuation is very attractive. The PE needs to go up. By the end of 2018, we see China Asia's PE ratio is only 10.3 times. Compared to its fair PE, 13 times. There is a 30% increase of PE. And we analyze the China Asia as a whole, we have around 20% increase from earning in 2019 and 2020. Therefore, when we compare it together, we have a 50% upside potential in 2019 and 2020. Using the same methodology, the situation become very different by the end of 2020 or the beginning of 2021. We can see after 2 years of bull market, the China Asia was not cheap anymore. The PE went up to 16 times, 6.1 times, which is 23% expensive than its fair PE. And we projected due to the low base effect in 2020, the year whole economy was hit by the pandemic. We calculate the earning growth rate should be 19%, and 15% in 2021 and 2022, respectively, which means over 30% increase from earning. Therefore, our conclusion was that from the beginning of 2021 to the end of 2022, 2 years, China Asia will only have 10% upside potential. For 2022, we still believe the projection we did at the beginning of 2021 still hold. 10% upside within 2 years. Last year, we can see the market has dropped 5.2%. Therefore, by calculation, our statement is that there will be a 15% upside potential in this year, 2022, for China Asia. 15% upside potential doesn't mean investors can make a 15% return if the investor chooses the wrong sectors to invest. By using the same methodology we did for CSI 300 index, we did the fundamental analysis for each sectors. And we are bullish toward 3 sectors: telecommunication, financials, and healthcare. In China, sector selection is very important. I think investors should put a lot of attention to this if you want to invest in China. Take the past 10 years, for example. If you put 1 million into China consumer staples sectors 10 years ago, you will get over 5 million principal plus gain by the end of 2021. However, if you put 1 million into China energy sector, you will only have 500,000 by the end of 2021. There is 10 times difference in terms of what you will get. So here is the end of my brief presentation. I believe we can go to next section.
So with this, we have reached our Q&A segment of this presentation. For this segment, I'll be asking Danny some China micro-related questions as well as some sector-related questions. So let's begin the first question. So for the first question, can I ask, following China's strong initial rebound from the pandemic, the recovery has clearly stalled in the second half of 2021, given that China's latest economic data fell below expectations. So should investors be concerned moving forward?
Okay. The potential growth in China is slowed significantly from double digit in 10 years ago to around 6% before the pandemic. And it is expected to slow further in the future. Without happening of a pandemic, we could see a 5% of growth annually. This slowing down reflects China's aging population, slowing productivity growth, a shift in growth away from high-speed growth to a high-quality growth economy. The pandemic has made this interrupted. A huge drop in year 2020, especially the first half of 2020, only negative 1.6% GDP growth. Due to the low base effect, we can see a large jump in the first half of last year. The low base effect has disappeared in the second half of last year, since China's economy has almost back to normal in the second half of 2022. Therefore, we see the recovery is already slow in the second half of 2021 when we do a year-on-year comparison. Looking forward, we believe we shouldn't overinterpret the China's economy data in the second half of last year. In 2022, we believe the growth will gradually converge but remain below to its pre-pandemic trend. After reaching over 8% in 2021, China's our projection is 8.5% in 2021, and we believe the Chinese growth is projected to slow to 5% in 2022. This is our projection.
Okay, another question I have is that real estate volatility has also been one of the major concerns for Chinese equity markets in 2021, following regulatory actions and concerns over Evergrande. So what is the expected impact on the broader market as we enter 2022?
Okay. China's government has initiated this real estate deleveraging for a long time and drawn three very clear right line to those real estate company. If you cross one of these right lines, it will become very difficult for you to borrow money from domestic banks. Some real estate listened, like Vanke, the biggest real estate developer in mainland China. And some companies didn't follow the regulation. Evergrande is one of them. So Evergrande Group actually breached all of these three lines after accumulating large liabilities in recent years. So looking forward, I think tightening of real estate is the right thing to do in the long term. It may cause some stress in the short term. And here are some key conclusions I want to make here. First, I believe the house activity has experienced a sharp slowdown, and it will in next several years. And the borrowing cost in US dollar bond markets has increased significantly for China real estate developers and other risk borrowers. The government is expected to continue to is focused on reducing the financial stability risk, but it will be less aggressive in 2021 than in 2020, less aggressive in 2022 than in 2021. And then I believe Evergrande's offshore debt are more likely to default than its onshore debt. And last, I believe the probability of systematic risk is very low.
So Danny, I have one more macro-related question for you. I would like to ask about China's recent energy shortage and the surge in the prices of upstream industrial metals or materials. So with this in mind, will China face the risk of high inflation?
Okay. Consumption price inflation remained pretty low in 2020 and most of time in last year, but accelerated in the final months of 2021 or November of 2021. It's hit 2.3% year on year in November. The December figure hasn't come out yet, but we believe it is a pretty high figure. The increase primarily reflected the higher upstream product cost. This is mainly showed in the producer price index. It's what we call the PPI index. PPI index has skyrocketed in 2021. So it's the right line on my left chart. Has reached its historical high in October 2021. Usually, consumer price index and the producer price index is highly correlated in China, as you can see from the historical data. We are also noticed the PPI is highly correlated to the money supply. In China, the difference between M1 growth rate and the M2 growth rate is the blue line on the right chart. It's a very good indicator, very good 6 months leading indicator actually for PPI, which means M1 minus M2 rise or drop, produce price index will follow within 6 months. Recently, we can see ME minus M2, this indicator has started to drop since July last year. Therefore, we believe we are expecting the PPI will fall soon, given maybe 2 or 3 months, and this will conduct to CPI, which is the key indicator for inflation, as we know. Can still go up for several months, but it will start to drop once its upstream product costs drop.
So moving on to the sector-related question, I have some questions about the 3 sectors of opportunities in which you pointed out earlier. So let's start with financials. The global financial sector had a great run in 2021, but Chinese financial stocks have largely lagged behind their international peers. So why is this the case, and what are some of the growth drivers for this sector moving forward?
Actually, Chinese financial sectors is not only lagged behind the international peers, but also lagged behind other domestic sectors. It has dropped 11.8% in 2021. It's more a 6% drop than CSI 300, which represents the overall China Asian market. Among 10 big sectors of domestic market, financial sector was performed at the bottom of third place in 2021. Why is this the case? To answer this question, first I want to show that what are some subsectors in financials. There are four subsectors in financial: broker, bank, real estate, and insurance. If you compare the performance of those subsectors with the CSI 300 performance, you will find out a broker and the bank sectors are actually outperform the market, and the real estate and the insurance are the major dragger. For the real estate sector, is related to the previous question you have asked, which is due to the tightening regulatory action towards real estate. Insurance has hardly hit by the pandemic, as more Chinese rather put the money into savings, preparing for the risk, than paying the premium to buy insurance. So looking forward, we believe the major reason for us to encourage our investor to put money into financial sector is due to the low valuation. When we compare financials PE and PB ratio with China Asia CSI 300 as a whole, is much cheaper and attractive for CSI 300. Both PE and PB CSI 300 is at 50 percentile level, which is around the average. However, for financial sector, the current PE is 6.7 times, around 10 percentile, which means its valuation is lower than 90% of its historical time. The current PB is even more obvious. It's only 0.8 times, which means the market price, because the PB is the market price to book value. So this means the market price is 20% lower than its book value. This is a clear indicator that I believe it means the Chinese financial sector is oversold.
So thank you, Danny. So for the next question I have is about China's telecommunications sector. So what are some growth drivers that could actually propel this sector going forward?
Okay, in 2018, as we all know, that the China-US trade friction began, and China was affected by the supply cutoff of the United States in high-tech field, which made the Chinese government realize the importance of developing its own high-tech industry. Therefore, in the past few years, many high-tech sectors in China has received a large influx of money from both government and VCs, which is why the high-tech industries such as new energy, new materials, and semiconductors has experienced a huge growth in the past few years in China. On the contrary, some traditional industries such as the real estate we just mentioned, oil industry, and the low tech industry has been suppressed. Now, many high-tech industry has seen very large gain, and the valuation are already very expensive. However, the telecommunication industry is still a sector that has not experienced a huge growth yet, but is a high-tech. So even though China has issued 5G license to 3 major communication operators as early as middle of 2019, we have not seen a huge increase of stock price in the telecom industry yet. Many of these companies has been suppressed by the China-US trade friction with the construction of more and more 5G base stations and the increase of penetration rate of 5G, as well as the popularization of applications such as auto driving, telemedicine, cloud gaming, and metaverse. The demand for 5G will be higher and higher. And we believe that the next maybe 1 or 2 years, more and more telecom companies will have a huge benefit from it.
So Danny, I have one more question, one final question for you. So if we dive deeper into the various segments that make up China's healthcare sector, what are your views on the health tech sector, given the government's calls for greater regulation of the fast-growing internet healthcare industry?
In China, the population aging has become a very serious problem in recent years. According to the data from the World Bank, China's population over the age of 65 has exceeded 7% as early as 2002, which is considered by many international experts to be an aging society already. As of 2020, the number of people over 65 years old in China has even exceeded 12%. And China is facing a crisis of getting old before getting rich. The Chinese government is actively response to it, such as phasing out the one-child policy and opening up to 2 or even 3 children. The government's crackdown on the real estate and the training industry in the past 2 years is also aimed to reducing the cost of housing and education for the citizens, so that everyone can afford to have a second or third child. Of course, we can also see the investment opportunity in the aging population crisis, among which the healthcare industry has great opportunity. If we study the healthcare industry in the United States, you will find out that many of the pharmaceutical-related stocks and funds has risen rapidly since 2013. Why is the case in 2013? This has a lot to do with the demographics of the United States. There is a generation in United States known as baby boomer, which refers to people born from 1946 to 1964, after World War II. And they account for about 1/3 of the current total population of the United States. The retirement age in the US is 67, and 2013 happened to be the age when the baby boomer began to retire. And when they retire, the medical needs began to sorrow. So we could see the US pharmaceutical company take off since 2013. In China, we also had a baby boomer. If you look at the right chart, it's after Great Chinese famine ended exactly in 2016 too, which is exactly 16 years ago from today. In China, 60 is the age of retirement. As the population over the age of 16 surges, the demand for Medicare and the Chinese society will soar, which will bring a huge profit to the medical companies, and this will push the stock price to go up. So this is the reason why I think the healthcare is one of the best sectors for us to invest in China. So I think this is the end of my presentation and Q&A. I hope I give you some useful information for you to invest in 2020, especially for those investors who want to put some money in China, Asia. So thank you very much, and see you next year.
Thank you, Danny and Chloe. We'll now proceed to our next presentation where Will Shum, Director, Portfolio Management and Research from iFast Hong Kong, will be sharing our views on the Hong Kong stock market, where we believe there is great upside potential. Will, please.
Hello, everyone. So this is Will. In my part, I will share my views over the Hong Kong equities and also why we are still positive on the Hong Kong market despite its disappointing performance last year. As you know, HSI, the Hang Seng Index, actually peaked at 31,800 points in mid-February last year before dipping lower. So last year actually full of negative news for Hong Kong China market, like the Chinese economic data has been really disappointing. Then you got the PBOC took numbers measures to curb the RMB appreciation, and then we have this tech giants were cracked down by the antitrust law. So this all happened in the first half. But what even worse is that since July, the Chinese government issued several regulations, policy targeting various industries, and also approved the infamous personal information protection law, which only impact on the China digital economy. So many other tech giants in the new economy sectors also affected. Then Evergrande debt prices also triggered concerns about the China real estate industry. So with all these negative factors, Hong Kong market has been one of the worst performer, of course, like HSI actually fell 14.1% in 2021, one of the worst in our coverage. From the mid-February high to the end of last year, the Hong Kong stock market has actually lost 25%. We are talking about the drawdown 25%. But look at this table. What really surprised us is that the fundamentals did not worsen as many people may expect, as we see that the estimated growth still being revised upward by 2.2%. There were no earnings downgrade, but only upgrade by 2.2%, and the earnings growth for 2021 remain largely solid at 18.2%. So you can see that the fundamentals for the Hong Kong stocks have not really worsened that much, even with the background of full of the negative news. And after declining, as I said, the drawdown 25%, right, since the peak in mid-February last year, the valuation of HSI became even more attractive. So here is the PB ratio. The price to book ratio of the HSI actually dropped below 1 time. It happens only 3 times before, which happened in 1998, 2015, and also the 2020. So this time is the 4th time that the PB ratio of the Hong Kong stock market has actually dropped below 1 time. We did some back testing and also find that if you buy at 1 time or below, PB ratio and hold for more than 1 year, the cumulative investment return are so attractive, and also the probability of the positive returns are actually very high. And we also take a look on another valuation indicator, which is the PE ratio. So the low level of the estimated PE is 10 times during this prolonged corrections. It's obviously quite cheap, and also already taking account into many pessimistic expectations. We also did some stress tests on the valuation, as many people's concern on various negative factors. We want to check whether the current valuation has already fully factored in the potential downgrading risk in the earnings. So with the fair PE of 12.5 times, the current PE actually implies a close to 20% earnings downgrade for 2022. So for us, it's quite hard to imagine that numbers of those large cap tech stocks and those so-called new economy stocks, which is supposed to be fast growing stocks, to plunge about 20% in terms of the earnings in the coming years. So it clearly shows that the valuations is really cheap, and market actually expect the earnings of the HSI to grow at 18% for 2021, and also about 12% for this year and also next year. So I think the earnings growth numbers are actually quite impressive. Like the consumer discretionary sectors was dragged because of the fines and penalties for the anti-monopoly law. For example, the market estimated that Meituan 2021 would turn profits into losses and then result into a slower growth for the whole consumer discretionary sectors. But the losses are expected to be reduced sharply this year, and will expect to turn profits in 2023. So it will become the growth engine again for the overall market earnings over the next 2 years. So overall, as you can see, Chinese tech stocks are expected to drive the earnings growth of the HSI, while the financial sectors will also help the acceleration of the earnings over the next 2 years. So among the major constituents, Alibaba, Tencent, Meituan contribute 55% of the decline to the index from the high level on 17th February last year to the low on 5th of October last year. So if if we can in Pinan, AIA, and also Xiaomi. So these 6 stocks contribute more than 70% of the decline, 70% of the decline. So as long as these stocks can actually stabilize and also start to pick up, it will help significantly to the overall Hong Kong stock market. But here I want to explain more a bit over a concern about the regulatory issues. Many people tend to be overreact to the news regarding any newly initiated laws or regulations coming out. Just an examples, previously we heard some the regulator actually announced some restriction on the gaming sector, right? So people will tend to think in the worst way, for the worst outcome, that Tencent gaming business will be done. But the fact is that we saw the officials stop or slow the new game approval process, but recently they have actually resumed it again, just like nothing has happened. For Meituan, also China official actually imposed a fine for Meituan at 3% of its 2020 revenues, which was equivalent to around 115 billion RMB. So the total penalties amount to 3.4 billion RMB, which was around 80% of its total earnings last year. But the fines was already slightly lower than the expectation, and also the things has already been settled. So 3.4 billion RMB was actually quite a small numbers if you compare to its last year revenue, what was over 100 billion RMB. So how come this 3.4 billion penalties will make Meituan to widen their loss, and also they keep earnings downgrades into their earnings by analysts? So the major reason is they actually make even more investment on the new business. The latest third quarter result shows that they have reached another record high quarterly revenue, which was over 50 billion RMB. But due to the monthly spent on those news areas like robotics, deliveries, group purchase, fresh purchase, and also fresh food purchase, and so on. So these are the key reasons that drag Meituan's earnings. It keep burning cash, and also for the new business. The people don't talk about this and only focus on the regulatory concern. But for us, it's just more than only regulatory issues. For Alibaba as well, it recorded its first quarterly losses in the first quarter or the fourth quarter of its last fiscal year due to the antitrust fine, which was about 18 billion RMB. But the issue is once again settled already, and its earnings result has not been too strong, especially for the latest quarter result. But there's nothing to do with the regulatory issues. It's about the fierce competition between other players like JD and also Pinduoduo. So JD and also Pinduoduo keep recording stronger growth in terms of the MAU and also GMV, whilst Alibaba seems to hit the growth bottleneck. So I think you can just blame the regulatory concerns, right? You can't blame even the pandemic issue coming back and affect the consumption cost. It is more about the business issue. Other players did better than you, so the share price already reflects the reality. But I think it's okay because it just that already at the JD. But what I want to explain here is that there's too much concern on the regulation. To me, sometimes business and earnings more matters. Do you think Charlie Munger buying Alibaba, will he concern about next few quarters earnings. I think he's more concerned about the business prospect, whether the current share price is cheap enough for him to enter into the buying positions, and what about the earnings prospect over the next at least 5-year times. So right now you can buy Alibaba with share price lower than what Charlie Munger pay. I think there's nothing to be too worried about. But just go back to this table. In the middle of this table, unlike what many people may think, major Chinese tech giants do not suffer a huge blow brought by the regulatory factors in terms of the earnings forecast, either for last year, this year, and also next year. So the estimated earnings growth of the HSI over the next 2 years remain robust. The problem is not about earnings. It is market has overreacted and investors lost their confidence. So in the bottom part of this table, you can see Alibaba's PE has fallen to the lowest since its listing. The lowest here, I mean, based on the data since its listing in the US in 2014, and Tencent PE also fell to the lowest since 2013. Since Meituan has not achieved sustainable profits, I use PS ratio, price to sales ratio here. But yeah, as you can see, also already fall to the lowest since listing. So the market is too pessimistic about the regulatory factors. But if the earnings growth of the 3 giants can meet market expectation, and their PE will, I believe that their PE ratio will be revert back to the historical mean, which will further drive the overall performance of the entire Hong Kong market. So the earnings growth of the financial sector of the HSIs will accelerate from last year 5.7% to 10% in 2022, mainly contributed by Ping An Insurance Group. Ping An's net profit in the first quarter of last year actually dropped 15.5% due to the provisions for the impairment losses of its investment in China Fortune Land. And of course, coupled with some devaluation of its huge equity investment in the property sectors amidst the China property sector's debt prices. Market are now expecting that a 17 YOY decline for its full year's earnings in last year, but its earnings will be normalized in this year, will contribute positively to the overall earnings this year. But yeah, the earnings growth of the financial sector are expected to be largely stable over the next 2 years. We think some of the positive factors have not been fully factored in yet, like a different the challenging macro environment and also the property sector mounting pressure of the economic downtrend. The PBOC has already taking steps to relax some restrictions on the bank loans, and also with the expectation on more policy to stabilize the credit, and these actions already implemented. So I think the total social financing may have bottomed out. It is also expected the new loan growth will accelerate again, which will further improve the bank's profitability. So coupled with the current low valuation and also high attractive dividend yield level, we believe that Chinese banking stocks will help push the HSI higher. So the reform of conducted by the Hang Seng Index Company in May 2020 to conditionally include companies with rated voting rights and also the second listed companies into HSI. So since then, the components of HSIs dominated, the newly added components of the HSI are mainly dominated by the new economy stocks with high growth and also high valuation. And by mid of next of this year, the HSI company target to have 18 constituents into the index, and the final target is 100. So the reform is trying to get more growth stocks in the index while lower the exposure of the those low growth sectors. So imagine that China mobile profits have been very stable at 110 billion RMB. Alibaba and Tencent profits in 2020 was 170 billion and 150 billion RMB respectively, but China mobile only shared 2.3% in HSI, while Alibaba and Tencent shares above 8%. Meituan, which only have 4.3 billion RMB profits, already shares nearly 9% of the index. So do you prefer to invest China mobile like company which provides you stable earnings, but it is already mature and do not have much growth potentials, or do you want to invest into companies like those big tech firms, which are still fighting against their peers? They're still burning cash. They're still increasing their costs to get more market shares on the new investment. But they are also more. They have more exciting potentials ahead, but may not offer very stable, sustainable earnings just yet. So I believe that obviously HSI already opt for the latter. So the proportion of the new economy stocks in HSI will keep rising. On one side, the index earnings growth rate will accelerate for sure. But on the other hand, if we talk about the impact of the further regulatory crackdown on the internet sector, right? For sure, it will be great as well. But these are more a short-term pain. For the longer-term perspective, the new economy sector will keep playing an important role under the dual circulation policy, and will keep making significant contributions to the China economic growth. We believe that when the concerns are fully digested, HSI will certainly benefit from increasing weightings of the new economy stocks, and its high growth, low valuation features will become even more prominent. So based on our calculation, based on the FPE of 12.5 times, HSI will rise to 35,000 points by end of 2023, with a potential growth of more than 40%. So that's the end of my presentation and sharing. So I hope our views on the Hong Kong stock market can give you some useful information and also some insights and some inspiration as well. So that's the end of my part. Thanks for watching, and I hope you enjoy. So I will stop here.
Thank you, Will. To cap off this segment on China, we'll now hear from Ken Wong, Client Portfolio Manager, China Equities at East Spring Investment. Ken is responsible for articulating the strategy, process, positioning, and performance of the various equity strategies within the Greater China region. And today, he will be sharing with us about East Spring's China A strategy and how it navigates China's new environment.
Thanks, everyone. Again, it was my pleasure to speak at the session today. What I want to do is over the next Okay, so hi everyone. This is Ken Wong here from Eastspring Investments. It's my pleasure to speak today at the Funds Supermart. What and where to invest in 2022. My theme today and my topic is very specific in regards to sort of navigating through China's new environment, because as we know, there's been a lot gone on over the past 6 or 7 months or so, and obviously a lot of investors now are asking what should they do. Just a very quick introduction into Eastspring for those who might not be familiar with us as a firm. We were founded in 1994. We're currently investing in over $250 billion in assets, and we're the asset management arm of Prudential. Now, let me provide a quick update, in regards to some of the uncertainty and some of the questions around China. As we know, in July of last year, there were, a lot of regulatory concerns around education as well as internet companies. And then, more recently, over the past few months, there's been concerns around the real estate sector again in China, especially with, some of the companies having overgeared and have actually had a lot of some of their bonds not being able to fulfill their dividend payments. But the fact is that when you look at a country like China, there is a lot of regulatory periods, and then there's a lot of booming periods as well. Over the past 20 plus years, you can see here that whether it be in the mining industry, dairy products, high-end liquor, gaming and drugs, and pharmaceutical related sort of medicine companies, there was a very strong boom period followed by a regulatory period. Now, this is nothing new to China, so investors should not be too overly concerned about some of the recent regulatory crackdowns that's been going on, because we see that all the time in China. That's the fundamental and the basics of investing in China, where there will be certain sectors going through a boom and then a regulatory phase. And this is something that we just see, and we've been seeing over the past 20 plus years. Policies matter in China. The fact is that policies play a key driver when it comes to the China A-share market movements, and they have been for the past 10 plus years. Through a number of different periods, whether it be whether it be RRR cuts, leverage financing, new asset management rules, the recent U.S.-China trade conflicts. All these things, have had a major impact when it comes to the China stock market. And also, this is one of the reasons why we feel at Eastspring that having a top-down approach, especially when we look at and understanding the macros and the policy cycles, it's going to be very important to be able to fulfill and capture the full opportunity and the potential that it is within the China stock market, in particular the A-share market, in our views. Now, we're going through some slowing headline growth with structural shifts, right? No doubt about it, China's economy is slowing down, right? By all means, we're expecting potentially to see maybe about a 5% GDP rise at most for 2022. Now, there's a lot of investors who might say, well, is that going to be reasons for concern? But our belief actually is that, you have to think about this in one way. Throughout the past decade, China has had very strong economic growth, but that did not lead to specifically the stock market in China doing well every single year. And so the stock market movements, as well as economic growth, are not correlated, right? They don't have any direct relations to say strong economy definitely means to strong markets, and weak economy definitely leads to a weak stock market, because that doesn't happen like that. And so this is one of the reasons why, we're not too overly concerned that the economy is slowing down. And despite that, if the economy continues to still grow at 5%, it's still going to be at a fairly strong pace. So this is not something that investors should be overly concerned about. Now, the other thing, and one of the things that we feel is going to benefit quite a number of different companies, especially within the A-share market, is China's path to common prosperity. The fact is that, common prosperity is becoming a very important social issue within China. This is kind of one way of China tackling ESG. When everybody's talking about ESG, one of the ways that China is going to tackle ESG, especially on the social side, is through common prosperity. The fact is that China really wants to have a much bigger growing middle class. One of the key main reasons for this is that consumption as a percentage of China's GDP is still only around 56%. You compare that with the rest of the world, where consumption as a percentage of GDP in places like Singapore or Hong Kong, or in the US or Japan or Europe, they're more like 75 to 80%. So that's why it's very important for that growing middle class to continue to generate more wealth so that they can consume as well in order for the economy to continue to strive. Now, previously, there was a speaker who was talking about China A shares, and our view is actually very similar. The fact that, we feel that China A share opportunity is a very good opportunity, especially this year, given the corrections that we saw last year, given the fact that when you look at the China A share market, it has, much lower correlations with global developed markets. So the fact is that their movements with other equity markets around the world are not really similar. China A share market is definitely a much more diversified marketplace. And despite specifically what's been going on, what we've seen is that, over the past few years, again, not 2021, but if you look at, sort of the market performance over the past 3-4 years, China A shares have done fairly well. But despite that, because of some of the pullback that we saw last year, the valuations are definitely looking much more compelling. And, the fact, as I mentioned earlier, because of some of the shorter term factors, and the more key aspect is the policy backdrop and the policy tailwinds that can help support the markets, we feel these are going to be very supportive and accommodative measures for China in 2022, right? Our scenario is that, what happened in 2021 with the regulations and the regulatory crackdowns, we think those will subside, in 2022. And we think specifically, investors, should look for especially those stocks that has underperformed over the past, 6 to 12 months or so. Now, in particular, the first point that I had mentioned earlier, when we talk about, China A shares not being less correlated or not being highly correlated with global markets, the fact is that China A share markets, we compare that with, let's say, Hong Kong or Asia ex Japan or emerging markets or Japan or US, Europe. The fact is that, their correlations is low. Anything in the green in this particular chart here basically shows that, the correlations tend to be a bit lower. And the fact is that the lower the correlation, the better when it comes to investors who wants to have a more diversified portfolio. And of course, when we talk about diversification and when you invest in the China A share market, one of the key things that we talk about being different as we compare the China A shares listed in Shanghai and Shenzhen as compared to, let's say, the H shares of the red chips listed in Hong Kong or the P chips listed in Hong Kong or the US listed ADRs, is the breadth. It's specifically the amount of stocks that you can invest within the Shanghai and Shenzhen A share market. There's over 4,200 companies which are listed in the A shares. Compare that in Hong Kong, there's only about 1,200 companies or so, about 1,200 companies, Chinese companies listed in Hong Kong. And the US, there's only about 275. And of that, there's probably going to be even a bit less with more companies delisting or more Chinese companies delisting in the US. So when it comes to being able to pick stocks, across a number of different sectors, the A shares is definitely the way to go. And, when we talk about the compelling valuations and so forth, the fact is that the China stock market, whether be it, the offshore market or the A shares, they're some of the cheapest stock market right now. The fact is that, the China stock markets, the Asian stock markets here are mostly, much more compelling, and they're very much undemanding, especially from a global point of view. So this is also another reason why, where, when we look at the underperformance, as I mentioned earlier, in 2021, and then when we look at specifically, the much more attractive valuations as compared to, a lot of the other countries around the world, these are very compelling reasons why investors should think about, investing in the market like China, in particular the China A shares. Excuse me. Now, when we talk about, China and some of the things that we're looking for, some of the longer term sort of secular views that we feel are going to be key macro drivers for China going forward will be a few things here, particularly domestic consumption upgrades, China's aging population, foreign capital inflows, and technology independence. Okay, these are all going to be key macro drivers which we're going to be seeing in China for the next 5 to 10 years. Okay, and some of the potential beneficiary sectors will include, consumer discretionary as well as staple sectors, healthcare, large blue chip stocks, as well as technology companies. Now, when it comes to investing, and when we sort of have this sort of longer term outlook, we also sometimes have to have some short term, sort of cyclical, views as well. And some of the views that we look at includes, monetary policies. Last year there was China's 14th five-year plan, some of the recent property market tightening measures. These are all things that we also have to look at as well. And that's why when I mentioned earlier, when it comes to investing in China, it's very important to pick stocks and select the right stocks. But with that said, you also need to be able to identify sectors which we feel and which we believe are going to provide actually much better performing stocks. And this is what we do here at Eastspring within our China A-Share team. Now, when we talk about our China A-Share Growth Fund, the key aspect of this is that our China A-Share Growth Fund is being advised and being managed by an experienced group of investment professionals based in our Eastspring Shanghai office. When you look at the lead investment advisor, Michelle Chi, she's had over 21 years of experience, investing and doing research work within the China A-Share market. What we try to do within the portfolio is, we try to capture a concentrated all caps best idea portfolios where, we invest in roughly between 30 to 50 stocks, focusing very much on the long-term growth perspectives in China. As I alluded to earlier, we focus both on the top-down macroeconomic situations in China, and then we also couple that with a bottom-up fundamental approach, trying to seek to really generate, as strong returns as we can for investors. And this is specifically the breakdown of the team that you can see, with the team headed up by Michelle, together with the other analysts within Shanghai office, and together with our colleague based in Singapore as well, Jie Lu, who also sort of works very closely with Michelle in regards to this portfolio. This whole investment process very much focuses on 4 steps. From filtering and trickling down the initial universe from 4,000 stocks to down to a pool of around 300 to 400 stocks. Then we focus on the top-down macro views and the sector allocations. Then it comes to some of the strategic sector allocations and stock selections. And then finally is really building the portfolio and ensuring, the portfolio that we have is the most optimal. So that's just really kind of what we do. And when we talk about the sector allocations, is a very important thing. We think, at least a third and even sometimes even up to half of our funds, outperformance really comes from sector allocations. During situations where, you have, let's say, a strong economy and let's say, sort of strong liquidity as well, a lot of times that benefits, some of the sectors like industrials, consumer discretionary, as well as consumer staple stocks. But again, there's much more than just understanding the macro analysis, right? We have to understand sector valuations. We have to also understand, some of the long-term growth drivers to really come up with a full picture to understand, which sectors we feel, given the current macro and policy situations, should actually outperform in the China A-Share space. And of course, the stock selection, once we identify the sectors we want overweight, becomes very important, right? We want to identify the best stocks with the highest possible upside over the next 12 months when it comes to investing in that particular sector. Now, when you look at overall, specifically, how our fund has performed, it's performed very well when it comes to specifically, sort of what we've been able to generate for investors. In particular, sort of when you look at our fund since the fund's inception, on average, we've been able to, generate roughly about 23%, sort of on an offer bid basis and a bid basis of 25%. So when you look at it, we've been able to outperform, first of all, the benchmark by nearly 11% per annum. And specifically, when you look at the fund, since the fund's inception, we've been able to generate 25% returns. Even over the past 2 years, when you look at, the overall returns per annum, we were able to generate 32% return per year, per annum. And specifically, that created an outperformance against the benchmark of about 6.5% a year. Now, when we look at specifically, some of the sector positionings and what we try to do within the portfolio, it is, like I mentioned earlier, a very important aspect when it comes to top down and when it comes to sort of what we're trying to do, which is really identifying the sectors which will do well. And of course, if we look at some of the sectors right now that we have key overweights in, will include consumer discretionary, will include specifically industrials, and also some of the material companies. Now, consumer discretionary, I talked about quite a bit, right? The fact is that because of the need for continuing rise in consumption, a lot of consumer discretionary related companies we expect should continue to do well. Industrials. Now, our belief actually right now on some of the industrial companies is actually a very key push and belief on EV car makers, specifically EV suppliers, battery suppliers, specifically solar energy related with the renewables. These are some of the key areas from our point of view we actually feel have a very strong sort of policy support as the Chinese government is really supporting these sectors. And at the same time, even going forward for the next few years, we think these are going to be key growing sectors which investors should continue to focus on, right? That you could see that potentially a new conflict between China and the US could be is who can become green quicker, right? Who can become more socially responsible, who can actually provide more clean energy or more EV vehicles at a much quicker pace. And in those instances, a lot of these industrial companies are going to benefit. IT companies, the reason why we like those, in particular, what IT companies we like, it's more the hardware, the semiconductor companies, because there's a global chip shortage, right? And the fact is that China is really trying to develop its own sort of semiconductor chips through various companies, and those are going to be exactly reasons why we feel are going to be key for China. And then when we look at some of the sectors like healthcare, healthcare, the fact is that the areas we like with healthcare actually has more to do with cosmetics. So some of the maybe dental related companies, or let's say some companies which are focusing on cosmetics or facials, or let's say even specifically beauty related products. These actually, from our point of view, even though they're healthcare, we think this is more of a consumer thing. Now, China's not going to crack down or stop people from trying to not have a better set of teeth or wanting to make themselves more beautiful. The fact is that that's part of consumption, right? If the middle class and others have more money to spend specifically on trying to make themselves look better, the fact is that these should be key consumption areas where we think China has a huge opportunity in the coming years. And of course, if you look at some of the key overweights and some of the positions that we hold, as I mentioned earlier, right? Some of the EV or EV type of cars includes like Geely, right? Even though Geely Auto is a company that's listed in Hong Kong, the fact is that we like Geely because it's going to be increasing or introducing a lot of EV vehicles over the next few years. And given the fact that its valuations are significantly much more attractive than some of the other EV players, that's going to be a company that we like. Other companies like Wuxi LED Intelligent or EBE Energy, these are going to be or even Mingyard Smart Energies. You can see that there's a lot of that theme here around EV, industrials, solar, renewables. These are all going to be sort of key areas that we want to invest in. And of course, the one area that we actually have a bit of our biggest underweight in, which might be of a surprise to some investors, is our biggest underweight is actually in Huachuan Maotai, right? The fact is, a lot of investors and we know a lot of people, definitely say, hey, you know what, Maotai is the biggest China A share stock, and so why do you underweight it? From our point of view, in people who are buying Maotai aren't individuals who are actually consuming them; they're giving them as gifts, right? And we see a lot of that happening in China, and so as a result, from our point of view, we just think that, given how valuations are, it's just really not that attractive. The growth prospects is that actually also not that attractive. So from our point of view, there's other companies that we would rather prefer within the consumer space. And of course, to kind of, I've only got a couple of slides here to go, but, I think another important thing when it comes to investing in funds is that, you want to be able to capture, with this particular chart here showing, is that you want to be able to capture, sort of the upside So to be able to outperform when the markets are up, so anything above 100% here on this red bar here means you're able to do that. And you want to be able to be under on the downside, meaning that, when the markets are going down, you're actually, sort of the fund itself is actually down less than the markets. And that's exactly what we've been able to achieve with this particular fund. And so finally, to wrap things up, I just want to, come up, sort of with this particular talk with a few takeaways for everyone to, sort of consider and when they're looking at investing. First of all, from a medium to longer term perspective, China's new regulations, it's definitely going to lead to a more balanced economy in terms of growth drivers as well as resource allocations. But this helps with lowering China's income inequality, which we feel will help drive consumption growth for the coming decade to come. Some of the recent regulatory concerns, overshadowing some of the policy supports, we feel that, despite everything that's been, sort of said and talked about with all these regulations, a lot of people have been overseeing or, sort of, not really focusing enough of their attention on, like I mentioned earlier, the renewables, the EVs, the semiconductors, the manufacturing. These are very much all aligned with national development objectives. And we think that especially within the A-share space, there's a lot of these exposures. And that is why investing in the A-share market makes so much more sense for investors who wants to have exposure to China. A-share stocks have favorable sensitivity to potential fiscal policy easing. So anytime when China needs to loosen up some of its policies, A-shares always tends to perform well as a result. When we saw A-share buying, in particular when we looked at the flows, last year was tremendous when it comes to A-shares. There was a lot of foreign investors who actually invested in the A-share markets, despite of all the sort of concerns, because when you see a lot of the regulatory sort of crackdowns, that had an impact on Hong Kong listed China shares and the ADRs. But in fact, if you look at the A shares, they did not actually have a large negative, sort of returns as a result of that, because A shares tends to be more domestic focused. And of course, when we look at foreign investors, the fact is that foreign investors still tends to be much more underweight towards China, and this is one of the key reasons why we feel that as more investors continue to understand what's going on, with more recovery coming from China, let's say with less regulatory, sort of concerns, and specifically, less crackdowns and so forth, we think 2022 is actually going to be a very good opportunity for investors to invest in the China A-share market. And so with that, I want to thank you very much for your time today, and I'm going to hand the floor over back to the MC. Thank you.
Thank you, Ken. And that wraps up this morning's segment on China, the rise of the phoenix. We will now head for a lunch break and resume at 1 p.m. right here. But don't go away. There are more presentations to come as we take a look at opportunities in Singapore, Asia, as well as in the US and Europe. If you have any questions regarding the presentations today, leave them in the Q&A section. We'll have our speakers address these questions later today. But don't go away yet, we have some exciting information for you. Receive 3,000 rewards points by opening a new FSM1 account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is WAWTI2022. Also, from now till December, FSM1.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. You can also take this chance to accumulate chances for the lucky draw, where 8 lucky showgoers will each walk away with a $100 FSM1 cash account credits. We will also have 3 grand prize winners who will receive $1,000 FSM1 cash account credits each. You can gain more chances to win a lucky draw by attending the event on both days, visiting sponsor pages, joining our daily quiz, and sharing the event via social media. Each time you do these things, you add to your tally of chances. Do ensure you always use the same ID and email address when logging in. Be sure to join us again for even more exciting presentations starting at 1 p.m. We'll see you later.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX Please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel.
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX Please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
Here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible and there will be a lot of programs, many different types.
I'm here on FAX Please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible and there will be a lot of programs, many different types.
I'm here on FAX Please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX, please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX, please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX, please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX, please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX Place.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX Place.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX, please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FAX, please.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
Here's my investment resume.
歡迎你嚟到我嘅 YouTube channel。
Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
Welcome back, everyone. I hope you've managed to have a great lunch break. Before we begin, I'd like to draw your attention to the promotions FSM1.com is running. Get to receive 3,000 rewards points by opening a new FSM1 account. If you already have an account, refer a friend to open an account with you, and both of you could receive 3,000 rewards points. The promo code to use is WAWTI2022. And from now till December, FSM1.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Now, don't forget also to accumulate chances for the lucky draw, where 8 lucky showgoers will each walk away with a $100 FSM1 cash account credits. And 3 grand prize winners will receive $1,000 FSM1 cash account credits each as well. Gain more chances to win the lucky draw by attending the event on both days, visiting sponsor pages, joining our daily quiz, and sharing the event via social media. Each time you do these things, you add to your tally of chances. Do also ensure you always use the same ID and email address when logging in. Following up, in the next segment, joining us in this panel discussion to kick off investing in our homeland Singapore are Lai Yu Huan, Senior Portfolio Manager from Nikko Asset Management, Adrian Chu, Vice President, Sales and Product Strategy, CSOP Asset Management, Yo Hui Shi, Equity Analyst, Stocks and ETFs Research from iFast Singapore, and Cyrus Ng, Analyst, Macro Research from iFast Singapore. They will be sharing about the bright spots of opportunities for Singapore and how investors can generate a long-term and sustainable stream of income, especially in uncertain times with local banks and S-REITs.
from the break. We have three speakers today, Yu Huan, Adrian, and Hui Shi, who will be sharing their insights on something closer to home, Singaporean equities. Thank you to our speakers for joining today. To start off, let's start with Hui Shi. The STI index climbed about 10% in 2021. What do you make of this performance, and was it in line with your expectations at the start of the year?
So the STI's performance in 2021 largely came in line with my expectations. The economic rebound has driven a recovery in corporate earnings, and in particular, the three Singapore banks, which are DBS, OCBC, and UOB, who make up about 40% of the STI, all did very well. So despite the low interest rate environment, they still managed to generate positive and strong earnings growth on the back of the easing loan provisions.
Yu Huan, do you have any thoughts on what she said?
Yeah, we agree that largely it was in line with our expectations. Markets were driven, of course, by the reopening, and the first half of the year really played out in that theme. Perhaps maybe what we did not anticipate as well was maybe in the second half of the year, the reopening, especially in Singapore, was maybe not as smooth as anticipated. And also in, let's say, amidst the manufacturing boom that happened, we also perhaps didn't anticipate the bottlenecks that occurred in the supply chain. But by and large, actually, the recovery in the economy and the market was within our expectations.
Thank you. Adrian, were they in line with your expectations?
Yes. So I would say the total return for the STI came in about 13.55% in 2021, right? Mainly driven by the banks amidst the macro recovery, expectation of interest rates hikes, which benefit from the bank's net interest margin. So, like just to echo Hui Shi, is that the STI has about 44% in terms of banks, right, which rose about 22% for last year. Top performer was DBS, which came in about 31%. On the flip side, Singapore REITs holds about 14% of the STI, gained about 3% return for last year, right? And it benefited from the reopening of the economy. And the index as a whole, is within our expectation. But for Singapore REITs, due to the Omicron late last year, sort of like affected the performance of S-REITs and a little bit fell short of our expectations.
Okay, thank you. Yep. You mentioned the Omicron as something that happened late in 2021. And in 2021, we saw the COVID-19 situation take multiple twists and turns. Mm-hmm. So do you think we will finally be past this pandemic this year? And if so, which companies and sectors do you think stand to benefit more from this transition?
Understood. So, it's a good question about the key concern is still the virus, right? And it's very hard to predict what COVID-19 will bring or the mutation will bring in the year 2022, right? And, globally, about 59% is vaccinated. This, on the flip side, means that 40% of the global population is unvaccinated. And that, gives more opportunity for the virus to mutate. And France just announced earlier this week that there's a new mutation, right? Mm-hmm. And according to Goldman Sachs research, they expect and they predict a large-scale viral infection in the first quarter of this year. And you could see that coming true with US reporting 1 million new cases a day just earlier this week. So that's the uncertainty that the virus might bring. On the flip side, on the local side, Prime Minister message, the New Year's message saying that year 2022 is going to be a year of transition, right? It's going to be a continued battle with the virus. However, we believe that the reopening of the economy, the story remain intact. And having said that, industrials, like which sector? I would say that REITs that include warehouse, logistics, data center REITs should continue to benefit from the structural tailwinds, pandemic or not, right? Office REITs definitely have a lower downside risk, delayed by supply and demand kind of from the new firms. In terms of retail REITs, right, suburban malls were definitely anticipated to be more resilient versus those malls along Orchard Roads. Due to the lack of tourists at this moment. Yeah.
Okay, thank you very much. Moving on to the economy. For Hui Shi, We saw rising inflation this year, and the Fed is likely hiking rates soon. And there's also talk that the MAS may tighten this year. So, which sectors do you think can benefit from this global monetary retightening? Tightening?
I think a sector that could benefit from this monetary policy tightening would be the local banks, because the main interest rate benchmark for the Sing dollar financial markets, which is the Singapore Overnight Rate Average, also known as the SORA, generally tracks the US federal funds rate. And the net interest margins across the banks were flattish over the past year as SORA was at low levels. And so when the Fed starts to hike rates later this year, I believe that SORA will also likely increase, and this will help to expand the net interest margins of the three local banks. And given that about 50% of their revenue comes from net interest income, these rate hikes will benefit the earnings of the banks as well.
Thank you. Yu Huan, do you agree that you
Yes, I do. And I mean, along the same vein, you find industries like, let's say, for example, insurance will usually benefit when interest rates rise because their liabilities are longer dated than their assets. But aside from that, also very traditional beneficiaries of inflation, like the industrials, because they will benefit from, let's say, the commodity cycle that's strong right now. Those are also sectors that we can look forward to that will benefit from an inflationary environment.
Okay, thank you. Adrian, what are your thoughts?
I would have to agree with the both of the speakers.
Okay, sure.
Yes.
So both financials and industrials.
Yep.
In addition to monetary policy, let's talk about fiscal policy instead. There's a strong possibility of a GST hike in the upcoming budget. So Yu Huan, how would this GST hike affect your stock picks?
Yeah, so I mean, a fiscal tightening GST hike normally would be negative for the markets, negative for the economy. So for us at Nikko, we are very much bottom-up stock pickers. So we go back to what we do normally, which is to pick stocks based on positive fundamental change and also sustainable returns. So this is what we will still focus on. Amid such an environment, we will be looking for companies which have strong business models, strong franchises that are able to pass on some of these increases in taxes, for example, to the customers. So we'll be looking for companies which are, for example, in the new Singapore thematic that we favor. These are companies operating in industries which are representative of the future of Singapore. Within these names are in industries like data, tech, renewable energy, for example. So lastly, we could also look for companies which have corporate restructuring angles. So within such a challenging environment that usually is brought forward by fiscal tightening, we will look for more bottom-up ideas with companies which are high-quality companies that will ride through this environment.
Thank you very much for your thoughts. So moving on to on a sector level analysis, financials are a key sector of the STI and it includes our three major local banks. So do you think the financial sector as a whole in 2022 can perform well? And which banks do you think can outperform the others?
So for the financial sector in the STI, it mainly consists of 4 different stocks, which will be the banks as well as the Singapore Exchange, SGX. But within this sector, I prefer the banks more because I think there are a lot of developments that could happen this year that could benefit them and which in turn can help to drive an outperformance. So firstly, like I mentioned earlier, rate hikes will definitely benefit those banks as this will help to expand their net interest margins. And besides this, I think another development to look out for this year will be loan growth. So loan growth, we believe it will continue in 2022, mainly being derived from the more resilient manufacturing sector, as well as the recovery of the property-related sectors such as construction, following the gradual reopening of the economy. And lastly, another factor would be fee income, especially wealth management fees. That will be a key earnings driver for the banks moving forward. So the three local banks, they are in a good position to capitalize on the fast-growing wealth management space in Asia, which is being supported by rising income levels from the wealthy middle class. And besides this, card fees, which has benefited from the economic rebound last year, is likely to continue on its uptrend this year as well. And so overall, the banks, they still remain well capitalized. So this reaffirms their positions to maintain sustainable dividend payouts. And I think on average, in 2022, investors can expect a dividend yield of about 5% from the banks. And in terms of valuations, I think that OCBC and UOB, they would be more attractive for investors given that they have more room for capital appreciation.
Yuhan, do you agree?
Yes, I agree that banks will do very well. In general, in a rising interest rate environment, the Singapore banks all benefit from having higher net interest margins. I'd like to highlight, though, of course, there are other factors. For example, like let's say DBS, for example, it's the most liquid bank. So in an environment where liquidity is scarce, the most liquid bank usually does very well. Apart from that, we also pay a lot of attention to another factor, which is the digital capabilities of the bank. So we think that digitalization will be a very important thing to look out for when selecting banks, because that would not only allow them to avail themselves of different business opportunities, but also allow them on the back end to save a lot on costs. So obviously, we think that a name like DBS has a very strong digital capability, and so that these are some of the factors which we believe will be important for stock selection in the financial sector.
Thank you very much for your insights. Moving on to another key sector of the STI, which is REITs. So, Hui Shi, among the different property names, which do you think can perform best in 2022, both in terms of capital appreciation as well as dividend yield?
In terms of both capital appreciation and dividend yield, I think that the industrial and the data center REITs, they could perform the best in 2022. For REITs, capital appreciation usually comes when there are expectations of an increase in their distribution per unit, also known as their DPU. And I expect the DPU recovery of the retail REITs, especially those that are focused on the Orchard Road malls, to be very gradual, especially if we take into account the near-term risks from Omicron. And on the other hand, to echo what Adrian mentioned earlier, even if there's a pandemic or not, there will be strong structural drivers driving the DPU growth of the industrial as well as the data center REITs. So, for example, the acceleration of e-commerce and also the shift from just-in-time to just-in-case inventory management in order to cope with the supply chain disruptions caused by the pandemic is expected to drive the demand for warehouses. And the pandemic has also accelerated several long-term trends which drive data traffic, and that in turn leads to a greater demand for data centers. So such trends will include increase in spending on cloud services, your emerging technologies, artificial intelligence, Internet of Things and 5G, as well as the growth of internet platforms. So I think that these trends, they make the industrial as well as the data center REITs very attractive, providing them with the potential for capital appreciation. And now in terms of the dividend yield, I believe most of the large cap industrial REITs like Ascendas, it is offering a yield of about 5% in 2022, and that is still considered quite decent as that is around the sector average. On the other hand, for data centers, the yield is slightly lower at about 4%, but that being said, there could be more room for further yield compression given that data centers are seeing robust demand post-pandemic. So in terms of total returns, I think these REITs could do well in 2022.
Adrian, do you agree on her stance on retail and industrial REITs?
Yes, I totally have to thank Hui Shu for backing me up in the sense that we prefer to look at the total return kind of criteria rather than just looking at the yield, because yield is just part of the investment story, right? High dividend yield stocks means that either the price has been stable or depressed. That's the reason why it explains a higher dividend yield, right? So we look at the capital appreciation and the yield as a total return kind of totality in terms of when it comes to investments, right? And the CSOP S-REITs Leaders ETF offers, a very well diversified portfolios of, large and mid-cap S-REITs, right? Or that's listed on SGX, or we call it Singapore REITs, right? To give investors, very stable long-term total returns, right? So in the last 5 years, the S-REITs Leaders Index has garnered a total return of about average 10% per annum, right? And what makes this leader very unique is because of the liquidity adjustment kind of strategies. There's 42 names in S-REITs listed on SGX. We get in the big boys into the club. And who plays in what positions is actually based on the liquidity for the last 6 months. And for the last rebalancing in September, we've seen there is a huge uptick in terms of retail REITs, and after rebalancing, that has actually put up more weight into our index and into our ETF. Now, what this liquidity adjustment does is actually it tracks fund flows, it tracks investors' interest into the particular sectors. This helps the index and the ETF to be more robust in terms of tracking, to be more relevant to the current economic situation. And having said that, our index, Leaders Index ETF right now comprises about 50% weightage and exposure into the new economy sector, such as industrial, logistics, and data center. And so this is actually our preferred sector due to the strong tailwinds of e-commerce going forward. And we also like office REITs as a whole because they would definitely likely fare better in this year, 2022, as Singapore shift away from the full default 100% working from home, opening up a bit by letting 50% of the workforce coming back to office. And then we believe that eventually they will come back to 100% setup, return office setup. So again, office REITs comprises about 23% of the Leaders Index in this case.
Okay.
Yep.
Overall, it seems you're pretty optimistic on SG REITs. So I guess if you could summarize what you mentioned just now about your ETF, could you perhaps summarize in a few sentences why you recommend this ETF?
Yes. So again, this S-REITs is this S-REITs index, right? It's actually based on the large cap. We get into the large and mid caps S-REITs on SGX. To be in the club, we rebalance it not on the traditional kind of market weight kind of weighting, market cap kind of weighting. We weight based on the liquidity for the last 6 months. So if for example a REIT has been actively traded for the last 6 months, this reflects investors' fund flows. And then so during our rebalancing at every 6 months interval, we would actually put in more weight to this particular REITs. This is just to signify, just to rebalance the portfolio to signify a particular sector that is actually very hot at the moment. So it keeps the index and ETF very robust and very up to date to the current market situation. Okay. So again, after 2 rebalancing, right now 50% is actually into industrial, logistics, warehouse, and data centers. So let us do the rebalancing for the investors right now.
All right, thank you. Moving on to Yu Huan. One of our recommendations today is the Nikko AM Singapore Dividend Equity Fund. So why would you recommend this fund for investors?
I think for investors who are looking to invest in our home market, Singapore, they really do have to consider a dividend fund because Singapore is a fairly mature market. It's got a lot of high quality companies, strong dividend payers. So having a dividend strategy makes a lot of sense, right? And also the fund itself, I'll talk more in my presentation, but the fund itself is designed to offer the best total return proposition by focusing both on dividend anchors as well as dividend growers. And we think that combination of dividend anchors, which are strong dividend payers, plus a little bit of growth, is really a very good package that will give investors a strong overall return for the investments.
Okay, thank you. We look forward to hearing more about your fund later. But just to sum up today, perhaps we could start with Adrian today. How will you rate Singaporean equities as a whole in 2022 compared to both ASEAN and global equities?
Well, I think maybe Yu Huan is actually better. But I would say that based on the STI right now, right, it's actually 40% into the large banks and 14% into the REITs, which are these are actually both like Yu Huan said, it offers growth in terms of the bank portion, and the REIT side is actually very stable and yet also offers investors income. So I would say comparing Singapore equities to the ASEAN equities, I think that we actually will categorize Singapore equities as a safe haven. Right.
All right. Yu Huan, what are your thoughts?
I think Singapore will do well because Singapore is traditionally a market that does well when interest rates rise because of the banks, let's say for example. And then traditionally you will look at some of the other ASEAN countries, perhaps like Indonesia, where in a rising interest rate environment, usually it is a little bit more challenged. Of course, the rising tide of the reopening will lift all boats. But I think Singapore is very well placed, both in terms of the interest rate cycle, as well as being the center of ASEAN, where it's also doing a lot of business with the rest of the economies. And if they do well, we will also do well.
Thank you very much to our speakers today, Yu Huan, Adrian, and Hui Shi, for joining us today and sharing your views on Singaporean equities. We will now hand everyone back to the MC.
Thank you to our various panelists. We will now proceed to the next presentation where we will have Lai Yu Huan to share more about the Nikko AM Singapore Dividend Equity Fund and why we remain positive on dividend stocks. Let us once again welcome Lai Yu Huan.
Good afternoon, and thank you everyone for spending time this afternoon to listen to us on our Singapore Equities Outlook entitled On Firmer Footing. This is the outline for my presentation today. I'll give you a very quick overview of Nikko Asset Management and then talk about the market outlook and why we think that the year 2022 will see Singapore on a firmer footing. We'll talk about how we design our portfolio to take advantage of this backdrop. And then lastly, we'll talk a bit about our Singapore Dividend Equity Fund. Straight on to the outlook, straight on to the introduction on Nikko Asset Management. We are obviously one of the largest asset managers in Asia, headquartered in Tokyo. But what I would want to highlight is that we have been managing actually Singapore equities for a very long time. And through our acquisition of DBS Asset Management in 2011, we've actually have some of the oldest unit trusts that's investing in Singapore, as old as the 1980s. So we've been investing in Singapore for a long, long history. On to the outlook on firmer footing. So I think on everybody's mind today would be, what's our view of what's happening with the pandemic, right? Omicron is certainly on everybody's mind. So our view is that we are cautiously sanguine on Omicron. Why? Because we think that the less serious effects of Omicron will mean that Singapore will be able to ride through the Omicron wave without too much stress to the healthcare system and without needing to resort to a further clampdown of social distancing. So we think that, so that sets the base for expectations for 2022 in that we are quite sanguine about the COVID situation. So a recap about the economy. We know that the economy in 2021 did very well. Yeah, we know that GDP growth was more than 7%. And in 2021, we actually already recovered all the lost ground of 2020, and the economy is already bigger than in 2019. So that sets a very stable and strong footing for 2022. Of course, 2021 was driven by a very, very strong manufacturing sector, right? We had a boom in our exports. In 2022, we expect this level of activity in the manufacturing sector to persist. We don't think that there will be a downturn, but of course, the rate of growth in manufacturing will be slower. But the good thing is, we think that in 2022, the baton will be passed on to other sectors like services and also construction, where the reopening will benefit these sectors and they will be taking over as the drivers of growth. One of the things that we can look forward to 2022, I think we're all looking forward to that, is the resumption of travel. We've already seen that in the last couple of months, and we've of course had the vaccinated travel lanes, right? These we've had arrangements with a number of countries, and the countries that we have VTL arrangements with now cover more than 50% of the tourists that would have arrived from these markets in any normal year. So of course, the capacity to these VTL countries are currently limited, but once we improve on our ability to handle VTL visitors, then these numbers will certainly these markets will be the big markets for us and will actually generate, I think, a gradual improvement in tourist traffic, which I think will gradually improve and to return to normal over the next 2 to 3 years. So it's a good time also to recap on the fundamental strengths of Singapore. You must. I think that investors sometimes forget and need to bear in mind that Singapore is a very well-managed economy. We have plenty of accolades, which actually has allowed us to ride through this pandemic quite smoothly. Amidst the pandemic in 2019 and 2020, in 2020 and 2021, FDI has remained strong. So if you look at the chart on the left-hand side, you will see that FDI in 2020 is practically at an all-time high. 2021 is, we've seen 9 months of it. It's slightly less, but I think still a very strong number. What's really, really interesting is the type of FDI that's coming in. If you look at the table on the right-hand side, you will see that these are coming in from a lot of new economy companies, be they e-commerce companies or companies like Zoom, or even companies which are old economy companies but in new economy sort of like areas like electric vehicles. So the investments are coming in very interesting areas in Singapore. The Singapore economy is a very diverse economy. We are diversified between manufacturing, finance, and services. And this is a strength that we've seen, for example, in 2020 and 2021. In an era where, let's say, for example, the services sector was badly hit by the pandemic, we've had the manufacturing sector pick up the slack. And we expect this to kind of reverse in 2022, where the growth is slowing down on the manufacturing side, but the services side, I think, will pick up the slack in 2022. So this diversification of the economy is really a strength when thinking about investing in Singapore. Singapore is also a leader in the digital race in ASEAN. You will see that this is the GMV, the gross market value of e-commerce transactions, is just a proxy for the growth of the digital economy. Singapore is not the largest part of these bar charts that you see here. Indonesia is very large. But why I say we are leader is because we have the people and we are the location for a lot of these companies. If you think about the 2 largest unicorns out there, Sea, which runs Shopee and which runs Garena, as well as Grab. They're headquartered in Singapore. In fact, Grab moved their headquarters down from KL to Singapore because of the quality of our manpower and the desirability of our location as a HQ. So we are a leader, and the growth in the digital economy in the countries around us will definitely be beneficial for Singapore. So overall, I look at 2022 as a continuation of the economic expansion that we've seen in 2021. So obviously 2021 we've had about 7%, and I think that 2022 will still be very attractive and will still be above trend, and 2022 will still look like a very strong year for the economy. And in tandem with that, I expect that corporate earnings will also grow very well. So of course in 2021 we've seen a huge rebound after the contraction of 2020. But I think that this momentum will be maintained, and this year and even next year will be years where the corporate earnings growth will actually be still quite attractive. What's also very interesting about corporate earnings growth is that in 2022, the makeup of corporate earnings growth will be different from in 2021. In 2021, it was concentrated a lot around the banks. But in 2022, you have a lot more other sectors, the services sectors, the trade sectors, also benefiting from the reopening. So when corporate earnings growth broadens out, it's a good environment for stock pickers like us, because it just gives you more opportunities to find good stocks. And this is another chart that says the same thing. In 2021, you will see that sectors like healthcare, sectors like manufacturing, of course, did very, very well. But in 2022, you will see the baton being passed on to sectors like transport, which is a beneficiary of reopening, as well as sectors like gaming, which is a beneficiary of the restart of international travel. The Singapore market is not expensive. On the left-hand side, you see the PE ratio is kind of about average. So we think that's not expensive at all. And on the right-hand side, the price-to-book ratio is actually very attractive. More interestingly, Singapore remains a very strong dividend-paying market. So the dividend yield level around 4%, I think is still a very attractive level. And certainly, we are one of the highest dividend-paying markets among our peers in the region. So just to give you a quick summary of our outlook. So we are cautiously sanguine on Omicron. We think that the reopening will be able to continue as well as together with the resumption of international travel. We think that there will be a continued expansion of the economy in 2022. And we also believe that the corporate earnings would recover in tandem. So we continue to be positive. So what stocks do we pick? What sectors do we pick in such an environment, right? I'll go back to this chart because clearly it shows you what sectors will do well. We've definitely invested in sectors like transport, which will benefit from domestic activity recovery, but also other sectors that benefit from the reopening, like retail, like hospitality a little bit. And as well as even commodity side where commodity prices are also stronger. The new Singapore is something that we've liked for some time. It's a thematic that that's very, very, very core to our strategy. And what is the new Singapore is basically, we coined this when Singapore was celebrating its SG50. And we were thinking, what sectors would be the most important sectors to the economy in the next 50 years for Singapore? And these sectors, I think, will be the most interesting to invest in. So we looked at the Singapore landscape, and these sectors will be, I think, in areas like data, tech, renewable energy. And also, tourism is there. I think that it will recover over the next 2 to 3 years. And some of the areas where Singapore is strong in, like let's say, for example, food solutions. So these we think are the sectors that will benefit from the economy of the future that we are also very keen to invest in. Again, also, we are positive on corporate restructuring. Corporate restructuring is a constant feature of the Singapore landscape, right? Amidst a challenging economy, corporate restructuring is accelerated. And we've seen many opportunities in 2021, including M&As, restructuring. So there are many opportunities within some of the Singapore corporates where they are, basically reshaping their business to take advantage of the economy of the future. And this we believe will be very interesting investment opportunities. So allow me to talk about the Singapore Dividend Equity Fund and how basically that is a good vehicle to kind of capture all these opportunities that I talked about. The key idea behind the fund is an attractive total return proposition, and that total return proposition comprises of both dividend yield and capital appreciation. That is achieved by basically the design of the fund. So the fund is designed to invest the majority of the fund in what we call dividend anchors. And this will be 70 to 80% of our fund, right? What are dividend anchors? They are mature companies. They're high quality companies, well managed in industries which are stable, and they have the ability and the willingness to give you a very repeatable and dependable dividend yield, right? A high dividend yield. But we also invest 20 to 30% of the fund in what we call dividend growers. Now, dividend growers may not be very strong dividend payers today, but they are high growth companies that we believe will attain dividend anchor status over the next 3 to 5 years. They will be the dividend payers of the future. So we believe that a combination like this is the best combination to achieve a very good total return proposition. We also have the ability to invest outside of Singapore. Currently, we don't do a lot of that because we want to stay very close to our dividend anchor and dividend grower kind of strategy. We have a number of REITs which are outside of Singapore, and I think they also fit into that anchor and growth kind of profile. So this strategy of dividend anchors and dividend growers, I believe, has been vindicated. We've had quite a number of awards over the years for the Singapore Dividend Equity Fund, and I think that speaks to the returns that it has been able to generate for our investors. So to summarize, we are sanguine on COVID. We think that Singapore will be able to ride through this Omicron wave without too much of a disruption, and that reopening will again proceed for the Singapore economy. We believe that the Singapore economy is very well placed. There's ongoing recovery that will take place in 2022 and the coming years, and that this will come together with an improvement in corporate earnings. We believe that valuations are reasonable, and that Singapore is one of the best dividend-paying markets. And we think that the Singapore Dividend Equity Fund, with its dividend anchor as well as dividend grower kind of strategy, is a very good kind of investment vehicle to kind of express this positive view on Singapore equities. Thank you.
Thank you, Lai Yu Huan. This wraps up our segment on investing in our homeland, Singapore. Coming up next, we cast our gaze toward Asia. Asian markets have come a long way over the past 20 years, but the question is, what is there to come for the next 20? From JP Morgan, we have Alexander Treves, Managing Director, Head of Emerging Markets and Asia Pacific, Equities Investment Specialist, Asia, to share on the multiple opportunities we see around our part of the globe in Asia and how we are able to capture these prospects. Let's welcome Alexander.
Well, good afternoon. What a pleasure it is to be speaking to all of you today. And I'm full of enthusiasm and excitement, not just because I'm talking to you, but because we're all living through the Asian century. And that's what I want to talk about at this particular session. Now, I don't know what's going to happen over the next year or so, but what I feel very strongly is that we are living through just the most extraordinary transformation, and that the Asian market environment will be so much stronger in 10 years' time than it is now. And all we need to do is figure out how to navigate from here to there. So let's go to my first slide, because I think that some of this narrative will be fairly familiar to you. When we go into the next picture, you will see that, as you know, there are hundreds of millions of consumers in Asia joining the middle class. And the standard story that you will have heard many times is that as all of these people get a little bit richer, they will buy more things, and this is driving the Asian economic miracle. But I get a little bit frustrated by that, because it really is only part of the story. That's about creating demand. That's about the opportunity set. That's basically saying, here are the revenues. But unless you have the sorts of companies which can satisfy those that demand, which will create the goods and services in an innovative way to meet all of those consumers' needs, then you're not getting the full picture. And so what I really want to do is focus on the next slide, please, because this is where things have transformed during the 25 years that I've been investing in Asia. And what you'll be able to see from this slide is that China, for example, but also some of the other countries have gone from being, and if we go to the next slide, please, China and some of these other countries in the region have gone from being really consumers of other people's goods and services to being innovators who manufacture themselves. And let's take a look at that sort of green line there on the left. Back in 1996, when I first arrived in Singapore, nothing you really bought or consumed was made in China. Maybe some garments, maybe some low-end furniture. But actually the story there was around China building out its own manufacturing capacity in low-end commoditized goods to satisfy the rest of the world. And what's really happened in record time is that China has gone from being this low-end commoditized mass market manufacturer to being one of the most innovative players on the planet. But that's not a story only about China. That could also address Taiwan, South Korea, large parts of ASEAN, Indian financial services and technology, etc. And this is super, super important, because if you have the consumption, but you don't have the supply, then you don't have investable ideas to make money out of. And that's why I get so excited about this chart. It's because Asia isn't just buying more things, it's also creating more things that people in Asia and around the rest of the world think are attractive. So when we think about how we want to invest in Asia, let's go on to the next slide, please, because there are various key themes which sit within our portfolios within the Asia growth strategy, which represent this. And these are really the conjunction of this, the demand side and the innovative supply side. So we have lifestyle upgrades, and I'll go into this in a little bit more detail. We have demographic changes, and we also have financial deepening. And each of those areas is broader than maybe you would appreciate at first glance. So let's go on to the next slide, please, and I will give you some examples about the sort of lifestyle upgrades we're seeing. Now, at the most prosaic level, we've got a large, relatively poor population in the region still, who are going from just being able to consume the most basic staples to being able to enjoy rather better goods and services. And so on the left-hand side, we have this theme of premiumization, which is another way of saying upgrading. This is people buying higher quality food, better frozen food, larger packets or containers of shampoo, better toothpaste, all of the branded things that you and I would take for granted in Singapore, but in a market like India is still quite aspirational. And as people get wealthier, they will only consume more of those things. But then in the new economy, firmly in the new economy, of course, we've got this growth of e-commerce. And while in staples, I would argue that Asia is still catching up with consumption in the richer world in the West, in e-commerce, quite often Asian companies are leapfrogging what's possible in the West. And of course, the story is still unfolding. So we do have markets like China or Korea, where already the e-commerce industry is really quite well evolved. But then we've got the whole of the emerging Southeast Asian region, which hasn't arrived at the party yet. And all of that will come. We can be very, very confident about that. The question is partly when, but we can be patient, but also how we monetize it. And then, of course, all of this isn't possible, including the conversation that you and I are having now, without what we see on the right-hand side, which is the hardware which supports all of the services which take place in the digital realm. And this is, again, where Asia just leads the story in Korea and Taiwan, increasingly in China, and more broadly, as Asia provides the hardware, which powers the software, the e-commerce, the gaming, the online video conferencing, etc. So these are all different areas of lifestyle upgrades, and we can be very confident that this isn't just a 2022 or a 2023 story. These are phenomena which will persist for 1 or 2 or 3 decades from here. Now let's talk about the next thing. So onto the next slide, please. And here we have demographic changes. And these manifest themselves in different ways. One thing is that when you don't have much money, you buy more food. When you have food, you buy transportation. When you have transportation, you buy accommodation. When you have accommodation, well, then you start getting more involved in the digital realm, etc. But the other thing which happens, of course, is that you're able to spend more money on health. And one of the things that COVID has done is it's only underscored the need for all of us to pay great attention to our health. And the exciting thing here, back to my theme, is it's not just around Asian people spending more money on their bodies and their minds. It's also around Asian companies being in a better position to provide the medicine and the healthcare and the medical equipment to satisfy those demands. So we have our now homegrown innovative pharmaceutical companies within the region. And on the left-hand side, you can see just how far China's R&D in healthcare is outstripping that in the US. Not yet in absolute terms, but in terms of the growth rate. And of course, that R&D is what will underscore future revenues in the space. It's underpin it. And in the middle, we have something which is even more sort of mind-blowing, which is the CRO space. Now, you may or may not know what it means. And if you don't, this is contract research outsourcing, which is where we have companies in the region who are now doing drug development on behalf of pharmaceutical companies within the region and elsewhere. So this is really, really cutting-edge stuff. And 20 years ago, if I said to you that China will have an entire industry where they will be producing Western medicine for people like you and me, I think you would not have believed it just yet, because we really couldn't participate in that. Well, now this is a very, very firmly entrenched phenomenon. And then on the right-hand side, we have a different element to demographics. And this is really the flip side of this sort of emerging middle-class miracle, which is, of course, one of the reasons that people in the middle class can afford to spend more is because they're being paid more. And if you're paid more, then you're more expensive. And if you want to manufacture things cheaply, then expensive workers aren't really what you're looking for. And so we see a long-run growth in industrial automation for Asian companies as they replace increasingly the sorts of people who had done low-end jobs with robots which can do them cheaper, more effectively, safer, etc. And again, this will just free up people for the more exciting parts of life. So it's a positive social story. It's also something which has many years to play out if we look at the penetration, for example, of robots in Asia compared with some other geographies. And then let's go on to my next slide, please, because financial services is an area which maybe feels a little bit more sort of boring somehow. It's incredibly important, but is there really innovation in finance? Is there a technology angle to this? And the answer is, well, yes, of course. And the conversation we're having now is an example of it. 4 years ago, it's highly unlikely that I would have been on a Zoom call with all of you on a Saturday afternoon using this format. But let's think more broadly around the larger populations in the region. The first thing is that Asia is still an underinsured market. And as I've said for both upgrading or premiumization, as I've said for healthcare, this is also the case for insurance, which as people get wealthier, they have more discretionary income to spend on things like insurance, in addition to the staples in their life. And so we've got very strong confidence that penetration rates of insurance will continue to rise, and it's a matter then of finding the companies who do the best job of serving those needs. Beyond that, in banking more generally, we know that retail bank services are underpenetrated in the region, and we have one particular data point here, which is the number of credit cards per capita. And you can see that in markets like India, these are still vanishingly low rates. And so all of this will carry on growing for a sustained period of time. And then, of course, mutual fund penetration is just another angle of this. So you might be saying, well, where's the technology in this? These are just mutual funds or insurance policies or current accounts. And let me take India to give you an example, but something like Indonesia would be a similar story. Unfortunately, in India, a depressingly large number of people are still illiterate. Now, that's not their fault. There's no judgment contained in that on my part. But of course, if you're illiterate and you can't read or write, then things like KYC, know your client, how you would onboard a new banking customer within all the anti-money laundering regulations and all of the restrictions, that's a seriously complex job. What India has done, and this might be old news to you, is they've got a unique ID system now where every single Indian has their own unique ID. And for people who can't read, they can use an iris scan in their thumbprint, which of course is unique to them, to identify them. So that's just a fantastic example of technology being used to make a service available to hundreds of millions of people and households who previously were unable to access something as basic as financial services. And that's only going to continue. The use of mobile telephones, the use of online banking, the use of UIDs and things like that, all of that will just massively expand the addressable customer base for these services. Now, I don't have to be clairvoyant to sort of imagine what you're thinking, which is I'm telling you this very, very positive story on a Saturday afternoon in January. But over the last year, we couldn't open a newspaper or we couldn't log onto the internet without some piece of sort of mind-blowing news coming out of China. I mean, what about this? What are the risks there? How can we have such a positive outlook when there's so much news emanating from China? Now, let's go on to the next slide, please. And this sets the bigger picture for what Chinese policymakers are trying to achieve. And I will let you into a secret here about the media, of course, which is they don't make money out of printing good news. And they don't make money out of printing no news. So if we just take a step back and have a look at the long run view in China and trying to understand what the policymakers are really trying to achieve, that will help us cut through some of the noise that we all get distracted by in the media and focus just on the signal of what really matters. And the key here is that the Chinese government is making a very deliberate trade-off. They are willing to accept a slower economic growth rate in the future than in the past, which is just a mathematical inevitability as people get wealthier, in return for a more stable and sustainable growth rate. And that sustainability manifests itself in social terms, which is to have a fairer society. It manifests itself in environmental terms. They want a less damaging environmental impact as they carry on growing the economy. And it also manifests itself in terms of the volatility of that growth. So they want less of the boom and bust, which affected China in the past, and a more stable growth trajectory. And that ties directly back into balance sheets. So on the next chart, please, we're going to start by talking about the internet, because this will have distracted so many of us so much over the last year. And what I would say is that although I will absolutely take issue with how some of the policies have been communicated, our view is that the Chinese regulation in the internet space has been more logical, targeted, and consistent than many people give them credit for. If I say to you that one of the aims of the regulation is to crack down on monopolistic behavior, I don't think you would find that controversial. If I say that one of the aims of the regulation is that companies should treat gig workers fairly and pay their employees properly, I don't think you would find that controversial. If I say to you that the regulation is there to prevent regulatory arbitrage between different regulators in different sectors, and also that it aims to ensure proper use of data and all of the rules around data and who's allowed to share what, I don't think you'll find that controversial either. In fact, regulators in the West have been doing this for some time. So our sense is that China, which has had a very, very light touch on internet regulation for some time, is basically just catching up with quite a lot of what's happened already in other geographies. And moreover, China is not anti-innovation. The government understands that so much of what China has achieved over the last generation is very firmly down to innovation. But what they want to make sure is that the big players don't unfairly squeeze out the up-and-coming smaller players. So that's what we see in the internet space. It's not always going to be an easy ride, but we think that taking a long run view, there is still plenty of opportunity here. Now, let's go on to the next slide, because there's another but moment, which is going to say, but what about geopolitics? And there's good news and bad news here. The bad news is if you are expecting there to be an easing of geopolitical tension between the US and China anytime soon, then you'll be disappointed. And that's for a simple reason, which is you can't go from a multipolar to a unipolar to a multipolar world, which is to say you can't go from having one superpower to two superpowers without there being quite a lot of headbutting between the big beasts along the way. But once you've learned to live with that, everything is fairly standard. There will be tension between the two countries, but they also need to live with each other. And in addition to the headwinds, there are tailwinds, and this chart illustrates one of them, which is that in the face of this tension, China is absolutely determined to become self-sufficient in a whole array of areas which previously it relied on imported goods for. So integrated circuits, office software, robotics, lasers, et cetera, because of the innovation that China has been doing, it can now manufacture these things themselves rather than having to import them. And of course, there's a large listed space which we can monetize to take advantage of that. And then there's one more chart I would like to talk about on China, which is the next chart, please, which is real estate. What about the real estate market? And on the slide that you are about to see, so the next chart, please, there is only one data point I want you to look at. And it's really, really small on your screen, so I apologize. But on the top right-hand corner, there is a small orange square. And what that shows you is Evergrande's debt as a percentage of the overall banking system. And the point is, you can barely see it. So going back to what I said about Chinese political, the Chinese political agenda, they want a more stable growth path. That means they have deliberately clamped down on debt in real estate and elsewhere. That means there's collateral damage. And if a company overextends itself and can't meet its debt obligations, well, capitalism tells you that's too bad, I'm afraid. That's just running your business poorly. But we think this is going to create a growth slowdown for the market, but nothing which is existential or systemic. So we think that the Chinese real estate is a sector to be extremely careful of, but we don't think there is anything there which is going to threaten the broader economic picture. So let's go on to my final slides, please. The next slide is just a topic which really we should be addressing in every single meeting. This is around ESG. I'm sure you've heard a lot about sustainability recently. Simply to say that we have been ESG integrated in our research process for nearly a decade already, for the very simple reason that unless you're thinking about the environmental impact of your companies, or about the social impact of the businesses that you invest in, or indeed the governance of the management teams that you're entrusting your capital with, well, then you can't make good investments anyway. And if you look on the right-hand side here, you can see that we're already overweight a leading electric vehicle battery supplier in China. Of course, this is an attractive area, irrespective of whether or not sustainable is a hot topic on a particular day. Of course, we invest in companies which look after their workforce and the broader community. And if a company doesn't take our interests seriously as minority equity investors, you can see in the bottom example there, then we will exit it. It's really, really simple. So my final two charts. So on to the next chart, please. This just shows you within our Asia growth strategy how we are positioned then at the moment. You can see that we are currently overweight financials for the reasons that I've illustrated. We're overweight communication services, and that can be a little bit misleading because that includes a lot of internet, such as social media and gaming. We're overweight IT, which tends to be physical IT, so hardware, semiconductors, DRAM, screens and cameras, all of that good stuff, the camera you're given your smartphone. And then we're typically underweight price takers rather than price setters. We're underweight capital intensive, low margin businesses. So things in materials, energy, real estate, utilities. These tend not to offer these attractive long run growth opportunities, which you and I want to invest in to benefit from the Asian century. And this at the moment leads us to be overweight Indonesia, Hong Kong, Taiwan, for example, to have less money in South Korea, where governance is trickier, where in China, where there's a large financial sector we're less interested in Malaysia, etc. But I should say that these sector and country positions are very much the outcome of bottom-up stock selection. And then if we can go on to my final slide, please, just to wrap up, an appropriate question to end with is, yeah, well, does this work? This is a nice story. How does it pan out? And if I can draw your attention, please, to the 3, 5, and 5-year and since inception numbers, you can see that over time, annualized, this is annualized data, net of, actually, this is composite, so this might be gross of fees, actually. But so annualized gross of fees, 5 years, this has generated 476 basis points of outperformance for our composite performance above the benchmark. So to conclude, I'm excited because this is the Asian century and I'm thrilled to be talking to you about it. I would counsel you not to get too caught up in what's going to happen next week or something, because there's so much noise in the media. But actually, if you just set your sights on what you can feel confidence in for the longer run, that's a really good way to invest. And taking this structural growth approach, looking for these businesses with long growth runways in trends which we know will persist for a sustained period of time, can yield some really attractive returns. With that, thank you very much indeed, and I hope you have a splendid, safe, and happy year.
Thank you, Alexander. Coming up next, we take a look at the ASEAN, one of the fastest growing consumer markets in the world. The region is also a major global hub of manufacturing and trade, which has given rise to many globally competitive companies. In this session presented by Jason Wong, Research Manager at iFast Malaysia, we will provide insight into one of the world's most dynamic regions. Joining us is Cyrus Wong, Macro Research Analyst from iFast Singapore.
turning to one of the more underappreciated segments within Asia, we have Jason from iFast Malaysia, who will share his views on ASEAN equities today. Thank you for joining us. To start off, Jason, could you give us an overview of performances of ASEAN markets in 2021?
Thanks, Cyrus. Good afternoon, ladies and gentlemen. 2021 was a pretty good year for ASEAN markets. In particular, the major ASEAN markets like Thailand, Singapore, and Indonesia all posted decent returns, with Thailand being the clear outperformer with a 12.9% return in 2021. On the other hand, the only market within our coverage in ASEAN, Malaysia, underperformed. After lagging its peers for most of the years, they ended the year with a negative 3.7% return.
Thank you. Moving on to Malaysian equities. Malaysian equities were among the worst performers in the ASEAN space. So why do you think they performed so poorly?
Sure. Malaysian equities, our benchmark for Malaysian equities is the KLCI index, also known as the Kuala Lumpur Composite Index. It was down 3.7% in 2021. The weak performance was more or less in line with the weaker earnings during the year as the economy and businesses were affected by the prolonged lockdowns imposed by the government in order to contain the COVID pandemic. Furthermore, there were several key events that happened during the year. For example, in August, we saw some political maneuvering which resulted in a change of prime minister. In addition, in October, there was the budget 2022 that was revealed, which saw some announcements that affected investor sentiment. For example, the one-time Cukai Makmur tax, the prosperity tax on corporates that earned more than 100 million ringgit per year, and also the increase of stamp duty for share transactions. The political and policy uncertainty have affected investor sentiment and weighed on markets in 2021.
Thank you. With so much uncertainty in 2021, do you think there will be a turnaround in 2022?
Yes. So going forward, with the economy finally reopening after the prolonged lockdowns, we do expect corporate earnings to improve. At this juncture, we think that earnings revisions have bottomed and priced in most of the negatives, such as the aforementioned Cukai Makmur prosperity tax. After being downgraded throughout 2021, we have seen earnings stabilize since October, which coincided with the tapering or the improvement in the COVID situation in the country, which allowed the government to fully reopen the economy and remove all these lockdown measures. In fact, in November, we are seeing slight upgrades to 2021 and 2023 earnings, which reflects better optimism from consensus or the analysts. KLCI earnings are expected to grow by about 6.9% and in 2022 and 8.3% in 2023, which may seem a bit sluggish, but if it is mainly dragged down by growth stocks, who are expected to see some normalization in their earnings post-pandemic, because as you all know, they did very well during the pandemic and they enjoyed super profits. But going forward, we do expect some normalization as we see demand for gloves start to come down and average selling prices start to normalize a bit. So if we were to strip out glove stocks from the equation, KLCI earnings growth are at much more palatable levels of 13.9% and 7.7% in 2022 and 2023 respectively. On another positive note, we are also seeing broad-based positive earnings growth in 2022 across most sectors except for the aforementioned glove sector. So earnings growth for KLCI index will be mainly driven by the biggest sector in the index, which is the financial sector. It has a weight of about 30.7%. The financial sector is expected to grow earnings by an impressive 10.8% in 2022 and another 7.7% in 2023. Amid a few key catalysts for growth, including higher net interest margins as the central bank, Bank Negara Malaysia, finally starts to raise interest rates in 2022 and 2023 after cutting rates to a record low of 1.75% in 2020. And secondly, we also see that non-performing loans will improve. And on the other hand, banks will also start to ease these loan loss provisions because as the economy recovers and reopens, this kind of ratios should improve post-pandemic. Another key driver for KLCI earnings growth is the consumer product and services sector, which is also expected to grow strongly in 2022 because of mainly the reopening of the economy after the lockdowns were finally relaxed. So we foresee that pent-up consumer demand will be unleashed as consumers will be finally able to spend in brick and mortar stores or dine in, whereas holidaymakers can resort to domestic travel to satisfy their travel itch.
Thank you. Following up on what you have said about earnings, it seems that you think that the earnings forecast is optimistic or might stabilize. So amidst this recovery, do you think there is enough upside for investors into Malaysian equities?
Yes. In terms of valuations, Malaysian equities do look attractive. The KLCI index is now trading at around 13.3 times forward PE based on 2023 estimated earnings. We believe that markets are pricing in some political uncertainty as the much anticipated general elections could be held in 2022. If we look at historically, in the past decade or so, it has only been this cheap 6 times. So for value investors, this could be a good entry level. And our fair PE for the market is 16 times, which represents a target price of about 18.15 for the KLCI index by end 2023. This equals to a decent 20% upside potential from the current level of about 1,500. On top of that, the estimated dividend yield of more than 4% in the coming 2 years could also bulk up the total return for investors. So all in all, we have upgraded our star ratings for Malaysian equities to 3 stars attractive. Previously, we have been neutral for Malaysian equities for some time, but now we think that it is time for investors to reconsider the underappreciated Malaysian equities. So we like the attractive upside potential, the cheap valuations, and the attractive dividend yields. That's my view for Malaysia.
Thank you. So it seems you are very optimistic on Malaysia. So moving on to another ASEAN country with a significantly better performance in 2021. So Indonesian equities were one of the top performers in ASEAN. Why do you think they performed so well?
Yes. So for Indonesia, it has been one of our favorite markets since the start of 2021. Our benchmark for Indonesian equities, the Jakarta Composite Index, also known as JCI Index, is up 7.8% in 2021, which is more or less in line with the positive earnings revisions that we have seen throughout the year. The EPS for 2021 was upgraded by about 10%, which reflected the better optimism by analysts amidst a better than expected economy, stronger commodity prices, and robust external demand for their products. So for Indonesia, similar to Malaysia, Indonesian earnings have stabilized and improved towards the end of the year as the COVID situation in the country improved. As you can see in the chart here, they have, since the second half of the year, we have seen a drastic drop in the number of new COVID cases in Indonesia as the vaccination rates in Indonesia picked up. So that's my view for Indonesia.
Thank you. So with stronger earnings as well as improving vaccination rates, looking forward to 2022, which key sectors do you think can drive the Indonesian market?
Yes. So for Indonesia, we are seeing also very broad-based earnings growth across all sectors, which is a positive factor. So in terms of the main contributors to this earnings growth are cyclical sectors such as financials, materials, which constitute a big portion. About 39% of the JCI index is financial sector, and 12% of the JCI index is the material sector. So these two sectors are the key contributors. Additionally, there are a few other sectors, namely the consumer discretionary, consumer staples, and communication services sectors, who are also expected to continue to benefit from the strong consumption growth from the young rising middle class population in Indonesia. So index heavyweight financial sector is expected to grow earnings by about 22.3% in 2022 and another 10.1% in 2023 amidst improving net interest margins amid a rising rate environment and also stabilizing non-performing loans. The growth in the financial sectors will be mainly driven by the top three banks in Indonesia, Bank Central Asia, Bank Rakyat Indonesia, and Bank Mandiri. In addition, the material sector is expected to see strong earnings growth of 22.6% in both 2022 and 2023, benefiting from the higher commodity prices and robust demand for the commodities and also its downstream products. But all in all, what we like about Indonesia is its broad-based growth, not just across a few beneficiaries of the reopening, but across all sectors.
Thank you. It's good to hear that you expect broad-based growth in Indonesian equities. However, given the strong performance we have seen so far in 2021, do you think there's still upside for Indonesian equities, or has the rally run out of steam?
Fundamentals for Indonesian equities still look quite solid going forward, with the earnings for JCI expected to see double-digit growth. So in terms of valuations, the JCI index is now trading at around 14 times PE based on forward 2023 estimated earnings, which is a few multiples below our in-house fair PE of 16 times. So there's still some upside. So based on our model, well, our target price for the JCI index is 7525, a decent 14% upside potential compared to the current level of around 6600. So as a conclusion, yes, we think there's still upside for the market and we continue to like Indonesia. Hence, we continue to rate Indonesia equities 3 stars attractive. So that's my view for Indonesia.
Thank you for your views on Indonesia. Finally, let's talk about Thailand. Thailand had a decent run in 2021, despite the lackluster economy. Is this reflective of fundamentals, or has the recent rally outrun fundamentals?
Yeah, so Thai equities, they have performed well in 2021. As you can see here, the SET index is up 12.9%, which is quite in line with the earnings upgrades that we have seen in 2021. In fact, earnings were upgraded by as much as 13.7% by the end of the year. This is supported by the strong exports, manufacturing, and also the robust external demand for their commodity products especially. They also benefited from stronger commodity prices like oil or oil-related products. Despite a difficult year for the tourism industry in Thailand, because as you all know, Thailand is a major tourism country, but thanks to the export sector, it has managed to hold up quite decently. In terms of going forward, the fundamentals for Thai equities look pretty solid. In 2022 and 2023, they're expected to see positive growth. And these EPS forecasts have also been upgraded since the start of 2021, which also reflects the more positive optimism from analysts. Going forward, the SET index are expected to grow earnings by 11.7% in 2022 and another 12% in 2023. So quite solid. And the earnings growth in 2022, however, is quite diverging, with certain sectors posting negative earnings growth and certain sectors doing better. But overall, 2023 is expected to be a better year for Thai corporate earnings, as we are expected to see broad-based growth across all sectors. So in 2022, earnings for Thai equities will be mainly driven by a few key sectors, as mentioned here. So firstly, there will be the commerce sector, which is expected to see EPS growth of 38.9% in 2022 and 25.7% in 2023. Very strong growth. This is led by the major commerce sector companies like CP or PCL, which is the 7-Eleven store operator in Thailand, and also Central Retail Corp PCL, which is the leading mall operator in Thailand. So the commerce sector is expected to boom or grow in line with the recovery in the domestic demand and also to a certain extent the return of international tourists. Another sector that's expected to grow strongly will be the financial sector. They're expected to grow 9.3% in 2022 and another 13.7% in 2023, amid strong demand for credit and loans and the stabilization of NPLs and easing loan loss provisions as the economy starts to emerge from the pandemic. The F&B sector is also expected to see strong earnings recovery after the pandemic hit last 2 years. They are expected to see EPS growth of 98.9% in 2022 and 25.8% in 2023, led by agro-industrial and food conglomerates, CP Foods PCL, and also the hotel and F&B retail operator, Minor International, who runs brands such as Coffee Club, Swenson's, and so on. Other than that, beverage makers such as Carabao Group and also Allsop Spa, PCL, they are also expected to benefit from the consumption recovery in the domestic and also their overseas markets.
Thank you for the in-depth discussion on Thai earnings. Based on the overall positive outlook for Thai earnings, do you think it is time then for investors to revisit Thai equities in 2022?
Yeah, so as mentioned just now, Thailand had a strong run-up in 2021, but we think that it has priced in a lot of the positivity already. In terms of valuation, it's looking unattractive as the SET index is currently trading at around 14.9 times forward 2023 earnings, not too far away from our fair PE for the market of 15 times. Based on our fair PE of 15 times, we estimate the end 2023 target price of 16.05, which is only 1% above its current level, which means that markets have probably fully valued the positivity and has little upside potential. As such, we maintain Thailand's rating at 2.5 stars neutral. And in fact, we think that investors can probably opt not to revisit Thai equities at this juncture, but instead can allocate their investments to other ASEAN markets that have higher potential upside, such as Malaysia and Indonesia that I mentioned just now. That's my view for Thailand.
Thank you for walking us through the different countries within the ASEAN market. To end off, could you please share with us some of your final thoughts on the ASEAN market?
Sure. Investors usually have little to no exposure in ASEAN equities in their portfolio because ASEAN equities are typically not in the radar of a lot of Asian equity funds. But going forward, I think investors should consider adding supplementary positions to capture the growth opportunity in ASEAN, especially in the few markets that I mentioned just now. In addition, ASEAN markets do provide additional diversification benefits for investors' portfolios due to their lower correlation to global equities. Thanks, everyone. I hope our viewers have some key takeaways from today's session.
Thank you, Jason, for joining us today and sharing your views on ASEAN equities. Let's now move back to the MC.
Thank you, Jason. North Asian markets surged sharply in the first 2 months of 2021, but soon experienced a fallback due to the rapid uptrend and the high valuations. If you're wondering whether such a volatile environment is going to repeat in 2022 and what strategies would work for the North Asian region, stay tuned for this presentation as we welcome back Will Shum, Director, Portfolio Management and Research from iFast Hong Kong, and Cyrus Ng to share more.
North Asian equities generally underperformed the broader Asian region in 2021. Should you consider buying them in 2022? We now have Will from iFast Hong Kong to take us through North Asian equities. Thank you, Will, for joining us today. Let's start off with Korean equities. Korean stock market was one of the best performing markets in the first half of 2021, but then it underwent a correction and became one of the worst performing markets in Asia, excluding China. It also underperformed Taiwan, another cyclical market. What do you think is the reason behind this poor second half performance?
Yes, true. The underperformance of the Korean market mainly happened since the second half of last year. It actually peaked out in July and then underwent a correction. So overall, Kospi gained 3.6% in 2021, even beaten by, actually underperformed by Asia's CSI 300 index, being one of the worst performing Asian markets if we exclude Malaysia, Hong Kong, and China. Here, China, I mean China H shares. So in general, we see some positivities inside the market, like the two internet giants, Kakao and Naver, two automakers, Hyundai and Kia, and also Samsung SDI being the key drivers for Kospi to keep positive returns for 2021. However, the performance of Samsung Electronics, LG Chem was disappointing, hindering the major market. But the disappointing performance last year actually got nothing to do with the fundamentals, like the corporate earnings are not should not be the one to be blamed. They actually not quite strong. Here is the table which shows you the estimated earnings growth last year. Actually, you can see that the estimated earnings growth last year is close to 100%, and 6 out of the top 10 constituents were expected to record a 3-digit growth. Even Samsung Electronics with the slower pace among the top 10 was also expected to record more than 50% worldwide growth. So given such strong earnings growth, the Korean market performance so disappointed, mainly attributable to few factors, supply chain problem, shortage in chips, which have resulted in a weaker than expected financial performance. And then companies started to lower their earnings forecast and also cut their earnings guidance. Then analysts start to downgrade their earnings forecast. And then we also see some negative policy towards the internet sectors, like the South Korean government actually took aim at those big internet firms on the antitrust issue, just like what the Chinese government did. And then we start to see some big tech giants to hesitate on expanding their business, like Kakao set up additional funds to support those SMEs and also workers, and also withdraw some of their aggressive plans on the business expansion. And the most important point, I believe, is that in 2020, the market performance actually quite strong, while at the same time we see the corporate earnings, the earnings growth just very close to zero. So I think for 2021 as the year to digest the strong performance. So yeah, that's the key reason to explain the performance for the Korean market.
Okay, thank you. Looking ahead to 2022, do you expect the fundamentals of Korean stocks to improve? And will these fundamentals be strong enough to support strong market performance next year? And what do you think overall are the drivers for 2022 earnings?
Yes, according to the Bloomberg consensus numbers, Kospi is expected to turned its strong positive earnings growth last year to negative this year, and 6 out of the 10 sectors will record negative growth in 2022. The communication service sectors, including the two large internet giant Kakao and Naver, is expected to have more than 50% YOY decline in earnings. In fact, the estimated earnings weakness for this year is not because analysts too pessimistic over the market outlook, either on the corporate side or the economic side. But of course, they do have some concern, like the persistent issues like the supply chain problem. But given such negative growth forecast, we're talking about 50% YOY decline for the whole sector. It's not just about the pessimistic issues. Some other issues also hinder the growth. And the key reasons is that some constituents of the Kospi record huge non-recurring income last year, pushing up the earnings base and leading to a lower earnings growth. So we exclude some one-off factors and recalculate the earnings growth for 2022. The Korean market is expected to grow by 8.6% for this year. Among them, the telecommunication service sectors, consumer discretionary, healthcare, industrial sectors may see more rapid earnings growth. The adjusted earnings growth can, I believe, can better reflect the reality, the real situation, like the two internet giants in the telecommunication service sectors will continue to benefit from the rapid growth of the new economy business, such as their digital advertising, e-commerce, cloud, and also fintech. And then those leading automakers in the consumer discretionary space are expected to stimulate the sales this year due to the launch of some of their EV series. And then for LG Chem, which is the battery stocks, will continue to benefit from rapid development of the EVs. So in particular, Apple has actually announced to work on the EV project, and it is said that the LG Group joint venture is highly likely to be included in Apple's supply chain. So you can imagine that LG Display, LG Chem, LG Energy Solution, and also LG Innovation, which all under LG Group will jump into the Apple supplier list. So which is believed to largely boost the whole material sectors in terms of the earnings, or even in the future, the share price performance. So these are the examples that shows despite the earnings figures provided by Bloomberg or the market consensus, you may still find many exciting investment opportunities in the market ahead.
Thank you. One theme that you mentioned in 2021 was the supply chain issues around the world. And the semiconductor sector is a key sector of the Korean market, but its recent share price performance has been dragged by factors like the supply chain issues and chip shortages. So do you think these issues really matter? And how will the semiconductor sector perform in terms of earning next year?
Yes, market concern about the supply chain issues will affect the shipments and cost of the parts and components, and then the rise in the inventory levels will cause memory price to fall, and also the consequence is that the decline price will further squeeze the profits. So analysts have lowered their earnings forecast for the top two semiconductor players in the Korean market, which is Samsung Electronics and also SK Hynix. Some analysts even said that winter is coming for the memory space. So you can feel that the pessimistic expectation actually led to the poor performance, share price performance of the top two largest semiconductor constituents. And the main reasons of this downgrade are based on the fact that the DRAM spot price have plunged by more than 30% since the end of June last year. Some analysts even believe that the demand has been very sluggish in certain space like personal computer, and also coupled with the rising inventory level, especially in the server memory, and also oversupplies situation seen in the graphic memory. So the memory price may further drop in the fourth quarter last year. So, but we believe that thanks to the technology development such as AI, data centers, 5G application, and more hot topic recently, which is the metaverse, memory will be applied even more extensively. So Micron already predict that the demand for the DRAM will increase by 10 to 20%, and also MAND will increase by 30% in its latest earnings guidance. The big three major memory makers already expect that the supply chain issues problems can be resolved by mid of this year. So the main reasons for a decline in PC shipments last year is the shortage of the non-memory components. So it is expected the memory sales in this area will rebound. So I think that the earnings prospect of Samsung and also SK Hynix expected to remain solid.
Thank you. To summarize Korean equities, are the current valuations of Korean equities still attractive? And what's your target price for the KOSPI in 2022 and 2023?
Yeah, KOSPI valuation has fallen from about 15 times at the beginning of this year to the current, last year to the current 10.6 times. So even during the pandemic period in 2020, the valuation was as low as 9.2 times, showing that the market not only ignore the robust earnings of last year, but also too concerned about the earnings prospect for this year due to different issues we just talked about. And of course, one of the key factors which make the consensus number doesn't look quite positive is because those one-off gains last year. But we try to exclude those one-off factors. The Korean stock market is expected to grow its earnings by around 8% this year based on our calculation, which is not very strong, but of course it is also not as bad as many investors may think. So most important is that the performance last year basically ignore the strong comeback in earnings in 2021, and market too concerned about the supply chain issues. So when the supply problems can be resolved and also relevant concerns can be relieved, so the market will recognize the improving fundamentals in this and also next year, then I believe that the valuation for the Korean stocks will be referred back to the historical mean. So based on the fair PE of 12 times, our target price for the KOSPI will be 3,650 points by end of 2023, with the potential upside of more than 20%.
Thank you for your insights on Korean equities. Moving on to Japanese stocks. What are your views on the fundamentals of Japanese stocks next year?
Yeah, for Japan, it is actually even more volatile than the Korean market last year. But basically in 2021, the returns for Japan market is very similar, very close to the Korean market. So both of them actually didn't really perform well, actually underperform most of the Asian single countries, only outperform Hong Kong, China, and also Malaysia. But for Japan, don't want to spend too much time to describe our market performance. But back to the questions about we saw strong earnings comeback last year, because the 2021 fiscal year-over-year earnings growth is estimated to be close to 20%. We also see analysts keep revising upward the earnings estimate. So in terms of the sectors, apart from the decline seen in the telecommunication service and also utility sectors, the rest of the sectors expect to record positive growth. So in particular, consumer discretionary, finance, and also industrial have stronger growth. Last year, the recovery will be continued in this and also next year, but you can see that the pace will be slower. Now, market expect the growth will be at 7.2% and also 4.6% in this and next year. The numbers far from strong, of course, in particular those sectors which have made large contribution to the overall market earnings last year was no. For example, financials and also industrials. The two sectors' earnings growth will grow at 4.3% and also 3.8%. Telecommunication sectors will continue to drag as people think that SoftBank will suffer from the decreasing number of IPOs and also of its underlying holdings in its vision fund and also the asset valuation, especially those Chinese holdings, will drop due to the market corrections and also as affected by the China regulatory crackdown. So it is the main reason for the telecommunication service sectors to be expected to record negative growth in this and also the next year.
Thank you. Drilling into earnings for the index, which sectors or constituents of the index do you think can drive the index performance in the coming years? And do you have any key points to note for any investors into Japanese equities?
Yeah, despite the slow overall market earnings growth, we find that there's still some sectors to continue to perform well, at least better than the overall growth figures, like the consumer discretionary sectors. We find that top constituents in the K225 index, fast retailing will grow over 12% next year. Sony is also expected to record a double-digit growth. The overall automaker sectors also expected to deliver 18% growth this year. Another sector that contributes to the overall earnings is the IT sector. The two largest constituents in the sectors, which are the semiconductor stocks, are both expected to deliver double-digit growth. So in the top 10, 6 of the top 10 stocks can record double-digit growth. 3 can only provide single digit, while 1, which is SoftBank, will be negative. But if we exclude SoftBank, the top 9 can actually achieve 8.9% growth next fiscal year, which is close to the overall market growth. One point I believe that investors should take note is that the currency appreciation, given that the Fed or the major central bank in the developed world is considering to quitting their loosening monetary policy, while the BOJ emphasized first several times that they have no plan to create any quantitative easing plans or asset purchase program. You can imagine that the yield spread will be widened between the different world as compared to Japan. As a result, we believe that the yen will likely to under pressure or to depreciate this year. As a result, we believe that investors can choose the USD hedge class or the hedge class for the Japanese equity fund to hedge against the potential currency appreciation risk.
Thank you for your insights on Japanese earnings as well as the Japanese yen. Moving on to valuation, do you think Japanese stocks are still cheap compared with other developed markets? And how much upside do you expect for the market over the next 2 years?
Yeah, in terms of the valuation, the low of last year was at 17 times, while the latest numbers is around 17.5 times, which is still below its fair PE of 18 times. One of the few developed markets which is still trading at discount in terms of the valuation. So I think in terms of the valuation, Japanese market is definitely still attractive if you look at the different markets perspective. And in terms of the earnings, the growth over the next 2 years not very strong, mainly driven by the SoftBank. But if one point can take note is if Chinese tech stocks can rebound and there will just one large IPO or few large IPOs for fiction funds holdings, then maybe there will be some revisions towards the SoftBank earnings. But of course, SoftBank still one of the risks that we should take note in the Japanese market. But overall, based on the 18 times fair PE, we calculate that Nikkei 225 target price by end of 2023 will be 34,000 points, which implies around 20% potential upside.
Thank you, Will, for your in-depth analysis on North Asian equities. We'll now hand everyone back to the MC.
Thank you, Will and Cyrus. The Indian equity market has generally not been the focus of many retail investors. However, investors should not ignore the fact that the Indian equity market has been performing very strongly relative to many Asian and global markets for the past 2 to 3 decades. Given India's strong growth and development potential in the coming decade, investors should definitely put India in their radar screen. Here to tell us more about the opportunity is Kenny Jen, Investment Director from IFA Singapore.
Good afternoon. My name is Kenny Jen, and I'm the Investment Director at IFA's Fund Management. My topic for today is why India deserves to be on your investment radar. I'm not sure how many of you have invested in Indian equities or Indian mutual fund before, or currently have any exposure in Indian funds or Indian stocks. My guess is that not many of you have Indian equities, and I would also guess that many of you are much more familiar with China or the ASEAN market as compared to India. I have to say upfront here that my purpose today is not to hard sell India to all of you, or that the Indian market is so attractive now that you should immediately start to invest in it. The purpose of today's presentation is to share with you some of the key facts of the Indian market that you may not know, so that when you decide to invest in India, you can make a more informed investment when you think the time and the valuation is right. I will basically divide today's presentation to three main parts. Firstly, I will give you some perspective why the Indian equity market has performed so well last year into 2021. Secondly, I will also share with you what are the key challenges that are faced by the Indian market this year. And last but not least, I will highlight the case why India will be an important market in the Asian region and why you should keep a close watch at it on your investment radar. Let me first show you how the Indian stock market has performed last year. So how well or how badly the Indian stock market has performed in 2021. As you can see from the chart here, and this is unfortunately dated only 10 December when I prepared the slides, the India stock market has returned more than 20% last year. And this performance has only lagged behind the US and the Taiwan market. It has significantly outperformed almost all the other Asian markets. So you may ask why India has performed so well in 2021. This chart shows you the 6 key reasons: ample liquidity, supportive monetary policy, better than expected macro recovery, positive earnings momentum and surprises, a sharp decline in COVID cases, and a rising retail participation rate in the stock market like what you have also seen in the US. I will go into more details in the following slide. India, like many central banks globally, has cut interest rate aggressively during the COVID pandemic to support the economy. As you can see from the chart here, the repo rate, which is what we call the repurchase rate, is also equivalent to the Fed fund rates in the US, has fallen to a 20-year low of 4%. The pre-pandemic repo rate in India is usually hovering around 5 to 6%. The cut in interest rate has released quite a bit of liquidity into the market, and some of this liquidity has found its way into the market and fueled the stock market rally in 2021. On the economic front, India's macroeconomic outlook has also improved vastly. After hitting a rock bottom of -7% in 2020, and this has been the worst for many, many years, GDP growth has rebounded sharply to 9% last year in 2021, and is forecasted to stay above 8% in 2022, that's this year. Although there will be some expectation of moderation to around 6% in 2023, it is still a very strong growth. India's current account balance is also in a much better shape today as compared to a few years back. Its current account balance as a percentage of GDP has improved from a low of -5% in 2013 to a positive balance of 0.9% in 2021. Foreign exchange reserve has also surged from around 300 billion a few years back to almost doubled right now, 600 billion currently. When you look at every stock market in the world, earnings momentum is a critical factor that will dictate the performance of many stock markets. As you can see from the chart here, India's EPS, which is earnings per share, has almost doubled after hitting a trough in mid-2020. This sharp rise in EPS has been the key catalyst for the strong performance of the Indian stock market last year. Investors' confidence has also received a big boost as COVID cases saw a sharp decline from a daily peak of almost 400,000 cases a day to maybe only a few hundred or a few thousand cases currently. Although the Omicron variant is ringing alarm bells again, but indication so far has been that Omicron causes less severe cases. So this can be treated as a consolation, but we must nonetheless monitor the development closely. Last but not least, more people were under lockdown during the pandemic and work from home became like a norm. And we have seen, as a result of this, more participation in the retail space in the Indian stock market. Retail participation through mutual funds or online trading platform has increased from 30 to 40% during the pre-pandemic period to a recent high of as much as 70%. Although we may see this percentage fall as the market corrects, we are likely to see the retail participation rate hovering in the 50 to 60% level. So after the strong performance of the Indian equity last year, the general consensus in the market right now is that Indian equities are not likely to perform as well in 2022. So far this year, it has actually done reasonably well. It has actually still in positive territory. But in other words, what many investors believe is that India is likely to underperform the other regional market. So what are the key challenges for the Indian equities in 2022? If you look at the chart here, these are the few key challenges. Firstly, India's valuation is trading at the high end of the valuation range relative to its history and also relative to the rest of the region. Secondly, other regional markets such as China or Hong Kong, which has underperformed significantly last year, may attract more money flows. The potential size of US tapering and the magnitude and pace of interest rate rises will also be a wild card in 2022. Rising energy costs and supply chain constraints may lead to inflationary pressure picking up rapidly, and this will have a negative impact to market sentiment. Last but not least, the Omicron spread and severity has to be monitored very carefully, as to me this is a wild card that can derail economic momentum. You can see from a chart here, this chart, what I'm trying to illustrate to you is the valuation of the Indian market. It basically shows that Indian market's valuation for the past 10 years. And you can tell that despite a bit of correction in the month of December, the India's market valuation is still not cheap relative to its 10-year history. India's current market PE is around 28 times versus an average 10-year price to earnings ratio of around 22.5 times. The price to earnings peaked at around 39 times in mid-2020. If you look at the valuation of the India market relative to the region, I just want to show it through this slide. It is also trading at a premium. The average premium over the past 10 years is around 58%. So India has actually been trading at a premium consistently over the past decade versus the other market. The current premium is around 71%. So this is actually higher than the 10-year average. Although we have seen it corrected from the recent peak premium of around 100%, there's still a real risk of rotation of money out into other Asian markets such as China this year. Another indicator to monitor very closely in India, and this is a very important indicator, is how the inflation trend will pan out this year and the subsequent year. Currently, inflation in India is still within the central bank's comfort zone of 4 to 6%. However, with rising energy costs and supply chain constraints globally, inflationary pressure is likely to tick up in the coming year. And this will see interest rate in India picking up, which will impact liquidity negatively. India is actually quite dependent on crude oil import. Oil import amounted to close to 30% of its total import bill. So a sustained high crude oil prices will definitely be inflationary, and hence will not be a good news for the stock market performance. So if 2022 is expected to be a challenging year for Indian equities, you may ask, why bother? As I have already mentioned in the beginning of this presentation, my purpose here today is not try to ask you to rush to invest in Indian equities right away. The purpose is to share with you some of the facts so that you can make an informed judgment in the event that you wish to invest in India. From an investment's perspective, this chart highlights some of the argument why you should put India in your investment radar. Firstly, Indian equity market has produced superior long-term performance. Secondly, India equity market has relatively low correlation with US equity market, providing diversification benefit. Thirdly, India's economic prospect is looking very promising. And like China, is evolving into a strong Asian economic giant. Lastly, there are positive secular trends developing in India's capital market, such as rising retail and institutional participation, and also we have been seeing increasing IPO activities in recent years. When I show you in my earlier slide how well Indian equities have done in 2021, you may wonder, is this just a one-off anomaly? Let me now show you a 30-year performance chart. The chart may look a bit small, but let me summarize some of the numbers. You can actually see from a chart here, which is starting from the end of January 1993 till the middle of December last year. Indian equities have a total return of 1,117%, which translates to an annualized return of 9%. This is superior to many other markets, except the US market, which has an annualized return of around 10.5% over the same period. I'm not suggesting or predicting that we can expect the same level of long-term returns, but we just simply cannot ignore the fact that Indian equities have been a good long-term investment. And another interesting to note about Indian equities is that it can experience large drawdown at times, such as the GFC, especially during crisis time. And it turned out always that investing into Indian equities when there's such a large correction to be the most rewarding. From a portfolio diversification or allocation perspective, India also provides a good diversification benefit. When you are investing in the US market, for example, you can see that the Indian equity actually have a very low correlation with some of the developed market equities, such as the US equities. So this definitely will help to kind of like offset some of the positive correlation that you get from investing in the same market. On the economic front, we also believe India is another Asian economic powerhouse in the making. Just to show you some perspective, both China and India has very similar nominal GDP in 1990. That's around 300 plus billion. However, in 2020, China GDP has ballooned or soared to US 14.72 trillion, 5.5 times larger than India. And you know that China and India has about the same number of people in the population. So we believe that this gap will narrow in the next decade as India economic growth accelerates, averaging 6 or 7% over the next few years, and China moderating in its economic growth. And also with rising personal consumption, private capex cycle, and infrastructure spending, this will continue to fuel the economic expansion in India. The COVID-19 pandemic and China-US trade war has also provided India a great opportunity to capitalize on the shift within the global manufacturing and supply chain. India has the benefit of a very large domestic population, and domestic demand potential is therefore there. And that's why it attracts a lot of foreign companies into India. And it also has a very large working age population. Global manufacturing firms has been setting up manufacturing facilities in India. For example, as this chart shows you, Foxconn Technology, I think some of you may know what is Foxconn Technology. They are a Taiwanese company. They are the largest iPhone assembler. They have already set up numerous manufacturing facilities in India and is planning to expand more. The other example is Samsung, also one of the largest electronic maker in the world. It has inaugurated the world's largest mobile factory in India. And Samsung has also launched its Make for the World initiative in its India plant, whereby it aims to export mobile handsets produced in India to overseas market. I mentioned earlier that there are also several positive secular trends developing in the India's capital market. Firstly, the COVID pandemic has fueled a sharp increase in retail participation in the stock market over the past 12 to 18 months. Retail investor share has grown from 33% in 2016 to about 45-50% last year. This was largely a result of a lot of the support of technology via easy-to-use online investment apps and the popularity of social media apps such as Twitter, Reddit, and Telegram. The penetration of internet to the remotest corners of the nation has also opened up a wide world opportunity and a whole new world of online access for the Indian population. This also meant improved accessibility to investment, education, market news, and growing awareness of the various forms of investment. Secondly, financial investment such as equities and mutual funds accounts for just a very small portion of the household financial assets, about 10% currently. With growing wealth and improving education, there's ample room for retail participation to grow. And lastly, IPO activities were very buoyant in 2021, amounting to more than $16 billion. This is likely to continue over the next few years, with companies in the traditional sector such as automobile, insurance, and the new age technologies such as education technology, e-commerce. Numerous companies in these few sectors are already lining up for IPO in the next 1 to 2 years. Now, perhaps I want to share you a quote with a veteran emerging market investment guru, Mark Movius. He recently said in a Bloomberg interview on India, and I quote, "India is on a 50-year rally. Even there are short bouts of bear market. India is maybe where China used to be 10 years ago." So you may ask, how can a foreign retail investors gain access to the Indian equity markets? Unfortunately, due to India's regulation, foreign retail investors are currently unable to invest directly in domestic Indian equities listed in the Indian stock exchanges. However, one can still gain access to India via managed fund, which is your mutual funds, the exchange-traded funds, which is listed in a lot of the exchanges. Selected Indian companies are also listed as ADR in the US exchange, but currently there's only 13 of them. So for more details, you can refer to the FSM1 website. And with this, I have come to the end of my presentation, and I thank you very much for your time.
Thank you, Kenny. We now turn our attention to the West and explore the West side story of growth. Europe and US equities has run up significantly in 2021 and valuations are at record highs. In this session, Chin from The Smart Investor is joined by Colleen Low, Assistant Manager, Macro Research at IFAS Singapore, and Cyrus Ng, Analyst, Macro Research at IFAS Singapore, to take a look at whether you should continue investing into these equity regions and discuss areas and sectors in light of the impending global recovery.
US and European equities saw solid performances in 2021, especially compared to their global counterparts. Today, we'll be taking a deeper dive into both equities with Colin from IFAS Macro Research Team and Chin from The Smart Investor. Thank you for joining us today. Starting off with US equities. They performed very well in 2021 with the S&P 500 recording gains of over 30%. Perhaps Chin could start. Could you explain to the audience what drove equities in 2021?
Sure. So good afternoon, everyone. I think that where I like to focus on is the S&P 500 because it's an index which consists of roughly around 500 companies. And these 500 companies make up, in terms of market cap, around 80% of the total market cap for the US stock market. So it's a significant and broad indicator of how stocks are performing. Now, when you look at the S&P 500 in 2021, it's the third year where they've actually recorded a double-digit return. And that's interesting, but for 2021, what is even more interesting is that all 11 industries which make up the S&P 500 have all recorded double-digit returns, which means that this is a very broad-based gain for the index itself. In fact, 8 out of 11 of those industries recorded 20% or more gains in terms of their individual industries, with the 3 biggest or best performers being energy, real estate, and IT. And of these 3, I think IT deserves special mention because in terms of weightage, it makes up roughly 29% of the S&P 500. So it's a significant contributor for the S&P 500 compared to the energy and real estate, which only makes up 5.5% in terms of weightage. So if you want to boil it down to one major factor, I would say it's IT and big tech in particular.
Colin, do you agree that IT and big tech drove US equities in 2021?
Yeah, absolutely. I think what Chin said was right spot on. So if you look at the S&P 500, which returned about 29% for last year, and you can look at the index performance for S&P 500 IT index itself, they returned about 35% in their local currency terms. And of that, the composition or what drove the 29% of the total return for S&P 500, a good 9% comes from IT. So you can see that the strength and the size of IT and the importance it plays. And really a big factor that contributes to why and how IT drove such performance is the earnings power of the sector itself. So if we look at the past few quarters, we see very strong earnings beat coming from the tech sector. And a lot of companies have, both the magnitude as well as the number of companies beating earning estimates have been increasing over the past couple of quarters within that sector itself. So tech sector is definitely one key driver of the S&P 500. And the second driver of S&P 500, I would say, is the financials index itself. If you look at the financial index itself, it drove about 4% out of the 29% gains in S&P 500 in last year's year-to-date performance. And within financial itself, you see that it on aggregate, it holds about 11% of the S&P 500, but it contributes about 25% to its earnings on aggregate. And with such a huge driver of earnings being from financials, if you look at the different banks and how the banks have performed over the past couple of quarters, we see stellar earnings results coming from these banks, and all these positive and earnings results have actually generated a lot of positive price reaction within the financials company, and therefore driving the S&P 500 as well. And aside from the sectoral perspective, if you look at from a style perspective, you also find that in the first half of the year, the S&P 500's performance is largely driven by the cyclical sectors such as your energy as well as your financials and your materials and industrial as well. And on the second half of the year, we see some rotation towards the growth sectors, so sectors such as your IT as well as your comms services and consumer discretionary, the big tech companies. And we see that style rotation are also answerable for how and why S&P 500 performed in that particular way over in 2021.
Thank you. Following on your comments on big tech, valuations for the S&P 500 have risen significantly, especially in that sector, and are currently at record highs. So our question is for Chin first. What are your thoughts regarding valuations, and do you think they present a risk or can they rise further?
Sure. So for me, valuation is a risk, but it may not be the biggest risk in terms, if you look at it from the point of view of an investor. For me, what is better to do when you're confronted with a scenario where you feel that valuations are high is to put aside the question of valuation first, put aside share prices, and look at the businesses which you want to own for the next decade. And I think that's really more important area to focus on, because business risk is not something you can manage easily. Valuation can be managed by portfolio management, but business risk is based on your choice of the company. And to me, that's a way more important piece of your investing process, which you need to focus on. By choosing a group of companies which you're comfortable to hold, you can then look at the valuation of those particular companies. You will have a list of companies to look at and be able to focus much better regardless of whether valuations are high or low. Now, I will make one comment about the NASDAQ, where it's down close to 8% from its high today, but 4 out of 10 of the NASDAQ stocks actually down by 50% or more. So if you're worried about valuation, there's a group of stocks which just got cheaper.
Thank you for your comments. Colin, do you agree on his views on valuations?
Yeah, absolutely. I think valuation itself, to some extent, presents a kind of risk. But the risk that I am looking at is the underlying catalyst that should or will be driving a possible valuation contraction. So where we are seeing valuation right now for the US, for S&P 500 in particular, with the current level of valuation, I think it lends a certain risk to a valuation contraction or valuation or a drawdown. So what we think will drive this valuation contraction are two things. Firstly, a disappointment in earnings, and secondly, in the expectation of that the Federal Reserve will turn more hawkish than what market expects. So for the first factor is the one that we are actually more focused on, we are more vigilant on, and because if you look at earnings and how analysts are looking at earning estimates right now, we see a lot of optimism on their end and a lot of expectation that earnings will continue to remain high for the next couple of quarters. But really beneath the hood, we are looking at some faults are starting to occur. So for example, if you look at cost metrics for the S&P 500, look at some of these important cost metrics, you'll find that in fact material costs as well as wages have been rising, and with that as our base case, we do expect some form of profit compression, especially in the second half of the year. And that if that results in earnings disappointment, we might see some valuation contraction, therefore some drawdown in the US market.
Thank you, Colin, for your comments on valuations. Back to Chin. One thing you mentioned is that for companies, we need to look not just at valuations, but at the individual companies itself. The big tech forms a big part of the S&P 500 index. How do you think big tech will perform in 2022? And do you have any preferred picks in the sector?
Wow, okay. So full disclosure, I've owned all the shares in FANG before they were even called FANG. So my longest holding is actually Netflix from January 2007. So that was 15 years ago. And I can tell you, having lived through this entire 15 years, I don't remember many moments where FANG was ever called cheap, right? So there's this interview from 2012 by Mark Andreessen, who's from the venture capitalist from Andreessen Horowitz. And this interview on Wired said two very interesting things, right? Number one, he said that there is no tech bubble. Now remember, this is 2012, right? And back in 2012, people were already talking about a tech bubble back then. And if you Google every single year after that, you'll find that the term tech bubble appears all the time. And I think everyone knows that if you had invested in FANG stocks any time in the last decade, you had done pretty well. If you missed out on that, you would have missed out on substantial gains. So why do people keep on calling it a tech bubble? I think that the one factor, and this is the second part of the interview, is that people has consistently underestimated the size of the market possible to grow. There has never been a time where there's a smartphone in the pockets of 5 billion people. There are 5 billion people connected to the internet before. This is a scale which has never existed before, and I think is severely underestimated till today. Now, today, of course, there's close to 5 billion people connected to the internet, but we just got here, right? I think the opportunities for internet scale businesses are substantial to build multiple trillion-dollar businesses in the future.
Thank you for your views, especially on internet companies. Moving back to Colin, do you see any key derating risks for investors to look out for in 2022?
Yeah, like I mentioned earlier, I think the number one derating risk that we are keeping an eye on is, of course, potential earnings disappointment. And that trigger for earnings disappointment will come in the form of higher costs for the US companies. And if you look at the recent data out there, the NABE, the National Association of Business Economics data, you will find that more and more companies, in fact, an increasing share of companies are reporting higher material costs as well as higher wages. And with the current level of that survey, it is also approaching is also approaching the historical peak level, which is seen from around 3rd Q or 4th Q of 2018. And that is a time where we saw costs skyrocketing for many of these US companies. So soft data is already pointing to the fact that higher cost is a possible reality. And when you look at the index level data, look at the COGS level data, as well as the OPEX expenses of many of these companies, we are seeing that both metrics are in fact rising and in fact have bottomed out and turned higher over the past couple of months. So if you combine the soft data as well as index level data, we have quite conclusive evidence that, okay, cost is indeed rising. But is it time to actually worry now? We think no, because earnings are still coming in hot. And what's driving earnings is, if you look at it, the underlying economic fundamentals, the corporate fundamentals are still strong. So we do believe that profitability will continue to come in strong over the next couple of quarters. But the issue with cost as a headwind might come in the second part of the year, and we therefore see more room for profit compression in the second half of the year, and therefore that may trigger some level of earnings disappointment if consensus continue to maintain such optimistic level, and therefore could be a major derating risk that I have my eyes on.
Thank you both of you for your views. Let's move on to the pandemic. The US seems to be managing the Omicron situation decently compared to other parts of the world. Do you think the economic reopening will remain a key theme in 2022? Or should investors show greater concern about the Omicron COVID risk? Perhaps we could start with Chin.
Sure. So I think in the case of COVID itself, including Omicron, the one thing which we've learned, having lived with it for the last 2 years or so, is to expect the unexpected, right? Now, the good news here is, even though that doesn't sound like the most reassuring message, we are not without a playbook. We are not back in 2020 where we do not know what's going to happen. I think that if you are concerned about any impact to the business, look at 2020 data, right? That is when shutdowns happen. It will show you exactly how those businesses are impacted. You don't have to guess, you don't have to speculate. You have hard data of how a company will perform during a lockdown, right? And if your concern is whether or not they are able to recover from that lockdown, look at 2021 data, right? Last year's data, and see how these businesses are able to recover. Are they recovering stronger? And again, you have data. So in fact, I believe that the stock market has given you a gift where you have all this data available. You can make your own playbook about which company you want to own and which company can sustain or recover based on the data which you have. So you're not flying blind, even though there's uncertainty.
Thank you for your views. We are indeed not flying blind. Next, we'll move on to monetary policy. We'll start with Colin. Inflation is currently running pretty hot in the US, and the Fed is set to do about 2 to 3 rate hikes in 2022 itself. So Colin, do you have any thoughts on Fed's rate hike plans, and what does this mean for equities?
Right. I think that's a good question, because this is definitely on most investors' mind after hearing what Fed's had to say over the meeting in earlier this week. So after looking through the minutes of the meeting, I think it can be said that there is a really high chance that we'll see rate hike and multiple times this year. So markets right now is in fact expecting rate hikes to come in around March, and for at least
2 to 3 times for this year. So I do agree with that. I think we are very likely to see rate hikes this year, and for about two to three hikes for this year. So if you look at the data underneath and supporting why there will be rate hikes, you look at primarily two things: inflation as well as the labor market. So when you look at inflation data, you'll find that components of inflation which are more sticky, which are like your wages as well as your rent. So these are the sticky components that result in more persistent inflation. Those data are indeed rising, and in fact rising at a pretty rapid rate. So with that said, if you look at the labor market data, you'll find that, job is growing at about 200K per month, and that is really at a healthy level, despite the recent job number being a bit of a disappointment. But I would say at this stage of the economy, it is a very healthy number. And if you look at wages, which is the more important thing, which is what the Fed looks at when it comes to making interest rate decisions, you'll find that wages itself has risen on an annual basis about 4.7%, and that has exceeded analyst estimates of 4.2%. And wages being such a big and important driver for inflation really comes to the play and really tells the picture that the labor market itself is in fact very healthy and growing well, and there's not much of concern for the labor market. So all in all, if you look at the labor market as well as inflation data, it really supports the fact that there is a high chance that we'll have rate hikes coming in soon. And on top of that, if you look at the potential impact of a rate hike on equity markets, like the key thing to note here is that there is always a historical relationship where higher rate hikes will tend to put some pressure on equity valuation. So I'll give an example. So we look at S&P 500 over the past few decades, you'll find that whenever interest rates have been rising, we'll find that the valuations for US equities have in fact at best level and at worst have contracted. So we think this time around will be no difference. And if the rate hike comes in faster than expected, I think there would be potentially larger valuation contraction. But if it is well telegraphed and guidance from the Fed is clear, then I think valuation may face less resistance. But that is the sort of potential impact I see from monetary policy on the equity markets.
Chin, do you agree with his views on the rate hike, and what stocks do you think can benefit?
So I think in terms of rate hikes, the way I think about it is it has to happen at some point. So Colin already pointed out some of the preceding indicators that is probably will lead to rate hikes. For me, that there hasn't been many periods or many years, if you look back in the last 20 years, where you have rate hikes actually happening. We have enjoyed quite a long period of low interest rates. For me, when I look at stocks confronted by such a situation, I look at their earnings power, right? I'll look at whether or not they have debt, because interest rates will impact the companies which have debt on their balance sheet. But if they are able to sustain themselves without any debt, if they're able to fund and sustain and grow their business without needing more capital to grow, then I think those companies are the ones which you want to focus on.
Thank you, Chin and Colin, for your views on US equities. Moving on to European equities. Colin, how do you think they performed in 2021, and what do you think will their performance be in 2022?
Right. I think European equities have been quite a dark horse for many years until recently, where look at flow data, we see more hedge fund has been allocating into European equities, and it has started to pick up some steam. So if you look at what drove return for European equities, we must first understand the nature of European equities, which are in fact more of a value cyclical play as opposed to the US, which is more of a growthy market. So there are three attributes that supports the very strong cyclical performance. So firstly, it is if you look at, for example, Stoxx 600, which is the representation of European equities, you'll find that about 60% of the revenue is derived internationally. Then if you look at the composition for the Stoxx 600, you'll find that around 60% are the more cyclical sectors as opposed to the more growth/defensive sectors. And also, if you look at the monetary policy direction in Europe right now, it is relatively more dovish than the Fed, and also compared to many parts of the world. So these three factors, when taken all together, really points to the fact that if the global recovery should continue, and in our base case, we think it will continue for this year, it's likely to be very supportive for European equities given its cyclical tilt. And that itself has driven a lot of the performance last year. If you look at the very cyclical sectors such as your auto sectors, your industrial, your energy in Europe, those are the ones that have driven the first stage of the recovery. And when we look at the second stage of the recovery, which is the more of a second half of this year, second half of last year, and the early parts of this year, we see that the consumer sectors are the ones that are driving that recovery. So the ones that are more cyclical, but at the same time less sensitive to the energy and industrial sectors. So we see a two-part cyclical recovery. And what do I think about European equities moving ahead? What I see two things that I really like as opposed to the US equities. Firstly, valuations level compared to US equities are still relatively cheap. So I believe European equities are trading at a 26% discount to US equity based on a forward PE ratio basis. And that is compared to a historical discount of 16%. So it is 9% discount more than what it's trading at historically. And if you look at what has happened over the past 2 to 3 quarters, we'll find that European equities are getting cheaper and cheaper relative to the US, while prices are very comparable. So gains over the past 2 to 3 quarters are quite comparable, but valuations are getting cheaper. And in fact, when you take that and together with the discount trading at the US, we find that there is definitely relative value in Europe, and there is a scope for valuation expansion. And if you look at the earnings, corporate earnings for European equities, you'll find that European equities tend to have a 10-year CAGR pre-COVID of about 4%. And moving ahead over the next 2 to 3 years, we are looking at a growth rate of 7 to 8%, which is about double the historical level. And a big part of it is driven by the cyclicality, like I mentioned. And overall, taking both factors together, we have strong earnings growth, relatively stronger earnings growth, as well as room for valuation expansion. We do see very strong upside as compared to the US. So for Europe, for example, we are looking at a 13 to 14% upside over the next 2 years. For US, we are looking at about 6% because of its valuation and on average. So therefore, comparing both upside as well as the underlying drivers, we are leaning more towards European equities.
Thank you for your views on US equities. For one final question for Chin,
Sure.
On the US market, how do you think investors should allocate their investments and overall in the US market and beyond? And overall, do you have any final thoughts?
Sure. So I think in the US, what you actually get is a market which is pretty homogeneous. You have same language, fairly large market, just the GDP in the world, high consumer spending. And I think if you take it for that benefit, you are able to find a lot of businesses that can build a substantial or have a very long growth path just based on the local US market itself. So that is what the US market offers you, right? So I do see it as a core part of your portfolio. It is personally a core part of my portfolio. If you like to venture into emerging markets and so on, you may be facing currencies which are less stable, political systems which may be not as mature, and also situations which we don't see very often in Singapore, right? Recently, I found out that in Kazakhstan, there has been riots and the government just shut down the entire internet, right? So these are the kind of risks which we usually don't think of. But when you go into developed markets, such risks are typically less present.
Thank you very much to both Colin from our macro research team as well as Chin from the Smart Investor for joining us today on our discussion on US and European equities. We'll now hand everyone back to the MC.
Thank you, Chin, Colin, and Cyrus. With US equities recording yet another strong year in 2021, what can we expect in 2022? How can the macro backdrop of monetary policy, inflation, and the pandemic shape the landscape in the coming year? Coming up next, we have Vanessa Huang, Vice President, Financial Institutions at Franklin Templeton, in uncovering the key drivers for continued growth in the US, the potential headwinds, and how Franklin US Opportunities Fund continues to unearth attractive opportunities for investors in the long term.
Hi, good afternoon, everyone. I'm Vanessa from Franklin Templeton, and today I am very excited to be here to share our insights on how the US equities market will fare in 2022. Okay, so before I dive into my presentation proper, I wanted to give you a quick overview on Franklin Templeton and who we are. I'm sure Franklin Templeton is a brand name that many of you will be familiar with, as we've been veterans in the asset management industry for over 70 years now. And as of today, we have over 1.5 trillion US dollars worth of assets, making us the 6th largest asset manager in the world. So of this $1.5 trillion of assets, we manage a very good mix of fixed income funds, equity funds, multi-asset, and even alternatives. And slightly over half of our assets right now are from retail investors like myself and yourself, while the remaining of our investors are actually institutional clients like sovereign wealth funds and pension funds. So here you can see that we have a very diversified suite of products and also a very diversified client base. So with that, let me now move on to our market views on the US. All right, so let me just take stock of what we've seen so far in the US. In this chart here, you can see that the US is now back to pre-pandemic levels of output. The green line here shows the nominal GDP of the US, and you would notice that it dipped very severely in March 2020 in that gray bar there. And as a result of the pandemic, but it recovered very sharply in the second half of 2020. So this resulted in a V-shaped recovery of the economy. So this is a term I think you would have heard very frequently last year if you were keeping up with the financial news. So this is actually the deepest recession that the US has seen on record, but it's also the most short-lived. And essentially what this chart is showing is that the levels of output are now higher than what it was in 2019 before COVID happened. Putting the US equities in a very strong footing and steady path for 2022, in our opinion. All right, so moving on to the next slide. Overall, we think that US growth is expected to remain very healthy despite this moderating economic momentum, which we think is very natural given such a huge upswing in the second half of 2020. So the chart on the left side here shows that the economic data has begun to moderate after this record recovery in the second half of 2020. Thus, this line chart is trending downwards. However, we are not too worried by this because if you look at the chart on the right side of this page, the light blue bars indicate that US growth is forecasted to grow well above the long-term trend, which is typically 2% on a quarterly basis. So if you look at this light blue bars, you would see that it's forecasted to grow anywhere from 3 to 5% in the upcoming quarters. All right, so it's also worth noting that not every country or region out there is forecasting a growth that's that above of their long-term average. Thus, this makes the case for why investors should continue to look at US equities this year, as we believe there are still legs for the market to run. Okay, so now let's address something that's on every investor's mind right now. Is the US equity market overvalued, especially with the S&P 500 finishing the year at about 28% last year. So this is the third year in a row where it finished double-digit returns, right? So in our opinion, the strong returns that we have seen are very explainable, and we really don't think that this is a bubble waiting to pop. But instead, we believe that there are strong fundamentals backing the valuations as corporate earnings continue to be very strong. On the left-hand side of this page, you can see that corporate earnings have recovered and are now surpassing pre-pandemic levels, while the chart on the right shows a large percentage of companies in the US are actually beating analyst expectations and surprising on the upside. So all in all, we believe that as the global economy starts to reopen this year in full force, the US companies will stand to gain and corporate earnings will continue to trend upwards, which will be a positive for US equities if you remain selective. So the next question is, within US equities, right, do we prefer large or small caps, growth or value stocks? Okay, so the chart here is very busy, but what it's trying to show is that the large cap growth and quality stocks have been in favor since last year. The blue line compares growth versus value stocks, while the green line compares the returns of large cap versus small cap stocks. So you see here that both lines have been trending upwards since the middle of last year, and this is despite the number of COVID infections in US, but illustrated by the gray bars in the background, right? So it's worth noting that our focus in the Franklin US Opportunities Fund is on growth and quality stocks. Hence, this makes us really excited as the data presented in the chart shows that this may be the sweet spot to be in if investors are looking for additional returns this year. Okay, so now within US equities, there's also many sectors to be invested in, right? And not all sectors within US equities are valued equally. Hence, we think that it's very, very important to stay active and use a portfolio manager with a very strong track record in investing in US equities, as we believe that investors will be compensated if they invest in the right sectors with stronger earnings potential. So the chart here, you can see that sectors such as IT and consumer discretionary stocks tend to trade at a higher PE ratio, and what this means is that they are a bit more expensive than other sectors. However, if you look at the horizontal axis, right, the growth potential is much higher in these sectors. So all in all, in short, although the long-term earnings forecast across many of these sectors may look compelling, it's still very important to remain active in your sector and stock allocation when you are investing in the US equities. So moving on to the next slide, where are we seeing value and opportunities right now? Okay, so at Franklin Templeton, we think that digital transformation is still in the early days of adoption, and it's forecasted to spur company growth as what's shown in this chart. So going into 2022, many of our investments still remain very focused on the ongoing digital transformation of the global economy. And we believe that this move towards digitization is allowing companies to, number one, better understand their customers. Number two, improve business processes. Number three, increase productivity. And all in all, this will eventually lower costs and hence making US companies more profitable. All right, so and if you want to invest in digital transformation as a theme, we believe that the US is actually the best place to be. So the US is home to leaders in digital transformation, and in this slide here, you can see in the survey, the US actually came up on top versus other regions in terms of world digital competitiveness. And all right, so if you're still not convinced why you should be looking at US equities this year, I think this chart is one of my favorite charts that summarizes it all. Okay, so US, over here on the right-hand side, you see US is actually trading at a modest premium relative to other regions, right? So that's why it's in the top right-hand corner. But then, when you look at the horizontal axis, you see the ROE, the return on equity, it is actually growing at a much faster pace compared to the other regions out there. So at Franklin Templeton, we do acknowledge that valuations are really actually not looking cheap right now, right? Hence, we expect earnings growth to be the driving force of returns moving forward. And it's important to focus on what we consider very high quality businesses with sustainable growth drivers that may not be reflected in current valuations. And moreover, like what the previous speakers spoke about earlier, monetary policy, right? The Fed has already started tapering, and we are going to expect at least 3 interest rate hikes this year. And this oftentimes it will not bode well for growth stocks on a broad level. Hence, we think that it's very important to stay active. And these are the high quality companies are the kind of stocks that will eventually that it will weather through the market volatility that we are going to see for the rest of the year. So with that, I hope the past couple of slides has helped us to set the stage for our outlook on US equities and the economy. Right now, I will give a quick intro and recap on the Franklin US Opportunities Fund, our flagship core US equities fund. Okay, so this is a high conviction fund where we typically own about 60 to 90 stocks on average. And you just think about this as our best ideas portfolio where you can get access to Franklin Templeton's top stock picks in the US equity space. And as mentioned earlier, this portfolio has a very huge focus on digital transformation and innovation, and it only invests in very high quality, high growth companies that are benefiting or will benefit from the shift to more digital ways of doing businesses. And we also believe that there's a huge long-term secular tailwind for growth in these type of companies, and this may not be fully reflected in current valuations like what I mentioned earlier. So one interesting thing about this fund that you can take away with yourself today, the lead portfolio manager, Graham Bowers, and his entire team, they're actually based in San Mateo, California. If you're familiar with San Mateo, California, this is actually right in the heart of Silicon Valley where all the action is. So we do believe that being situated at the heart of Silicon Valley is one of our true advantages, as the team is near all the leading tech companies and VC firms. And this proximity really helps our analysts to gain first-hand insights to what's going on in the tech scene. So we do believe that, since we are investing alongside the digital transformation theme, being based in Silicon Valley is a true advantage. So now let me just move on and touch on some sub-themes under the digital transformation theme that have emerged coming out of the pandemic. So these are just a few of the themes. So firstly, healthcare innovation. So during the pandemic, consumers like myself and yourself, I'm pretty sure at least half of us would have used telemedicine, right? So we were kind of introduced to this whole concept of, video calling your doctor and, talking to him. And then after that, you don't even need to go down to the clinic to pick up your medication, but instead they will just deliver it to your doorstep. So we do believe that this has created more efficiencies and is reducing time spent waiting in the clinic. So we're very positive on this sector. And on top of that, we are also very positive on genomics. The pandemic has showed us how advances in gene sequencing can lead to faster and better treatments for disease. And this expedited research and development process for the COVID-19 vaccine is the result of genomic advancements. So we are very excited on genomics, and we do believe in the next 5 to 10 years, this is an area that we should be looking very closely in. Okay, so secondly, another sub-theme that we're looking at is financials, okay? So in this portfolio, we do not have any exposure to banks, but instead we are more interested in fintech companies. As we start to move to a cashless society during the pandemic, we're seeing the rise of many of these fintech companies that's focused on providing this service. So while these companies in the fintech sector were really not immune to the effects of COVID-19, we do believe that these contactless habits and the shift towards a cashless society spurred by this pandemic are likely to continue, especially with this rapid growth in e-commerce, which has accelerated credit card use and other online payment services that allow for contactless transactions. And last but not least, I'll just touch on consumer spending patterns. I think this is a sub-theme that a lot of us can relate to. Over the past 2 years, 1.5 to 2 years, we have been introduced to a tremendous number of new options on how to go about our daily lives, and hence changing the way we spend our money. So we expect many of these digital behaviors pursued during the pandemic, like remote working, shopping for groceries online, in-home exercise, or telemedicine to continue long after the economy fully reopens, right? So this is a couple of the sub-themes that we're positive on in this sector that makes us really excited. And next up, I'll just talk about our sector allocation. So this is our portfolio sector allocation versus the two benchmarks which we measure ourselves against. Firstly, the Russell 3000 index and the S&P 500 index. Okay, so these portfolio weights actually reflect the PM's conviction, the portfolio manager's conviction, and not the benchmark. So we really do not tie ourselves down to the benchmark, but instead these sector weights are a result of the various sub-themes that the investment team is positive on. So over here you can see that the portfolio is currently overweight in IT, healthcare, and financials. And just to note, the financials that we own are fintech companies and not your traditional banking stocks. Okay, so next slide. This is our track record, our very strong track record. The fund has been around since April 2000. So we have close to 21 years of very strong track record. So in the chart on the left, you can see that we have outperformed our peer group, other US equity funds out there in the 3, 5, 10-year period. And the chart on the right shows the cumulative performance of our fund versus the peers. So what this really means is that if you bought into Franklin US Ops 10 years ago, you put in $1,000 and you stayed invested all the way. You didn't put in extra money, right? So if you fast forward 10 years to today, your money would have more than tripled by now. Versus if you put your money in other US equities funds, it would have probably only doubled, slightly more than doubled. Okay, so that's how you read this chart. Okay, so I've come to the end of my presentation, but before I go, I really just wanted to summarize what we discussed earlier, okay? So why US equities now? Firstly, we think US markets offer exposure to long-term secular growth trends, such as digital transformation, which we think is still in its very early days, and there's still a lot more value to be unlocked. So secondly, we think the US growth still remains very attractive relative to other markets, and really not many regions out there are forecasted to grow at the same pace as the US. And last but not least, we do believe as long-term investors, you can benefit from being exposed to US equities. So next, why Franklin US Opportunities Fund? We have close to 21 years of track record, like what I mentioned earlier, and the main aim of this fund is to capture leading US companies poised for growth. And we like very high quality, high growth companies, and these stocks are selected from a bottom-up basis by our team based in Silicon Valley. So this is also a very diversified portfolio that has exposure across market caps and multiple industries. And like what I mentioned earlier, it has a very strong track record, so I'll just let the numbers speak for itself. So with that, I've come to the end of my presentation. Thank you so much for your time this afternoon. I really hope you found this session insightful. With that, I'll just hand the floor over to our MC.
Thank you, Vanessa. In just a short moment, we will head over to our speakers at the Q&A panel, where Catherine, Colleen, Hui Shi, and Wei Ren will be on hand to respond to your questions from today. However, if you have any more questions, you can leave them in the Q&A function. But of course, don't go away just yet, because after the Q&A session, we will be holding our daily quiz. This is sponsored by our platinum sponsors, CSOP Asset Management, East Spring Investments, and Nickel Asset Management. 6 winners will each walk away with a $100 worth of FSM multi-currency cash account credits for the fastest and most accurate answers. We'll be back with the Q&A shortly.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
Thank you for joining us for the Q&A session. We really appreciate your attention throughout this whole very long day of presentations and investment ideas. I do hope that all of you have learned something from all the presentation, and also thank you for your questions that you have keyed in the comment boxes. So today, with us on this panel list, we do have Weiren, Colleen, as well as Hui Shi to answer some of these burning questions. So I think one of the very popular questions, especially among the investors that we speak with, and also in one of the questions in the Q&A comments, is that given that Fed will actually increase the rates in the coming months and years, like how should we actually position our portfolio, and whether or not investing in fixed income funds would still be relevant? So I will direct this question to Colleen.
Yeah, so this is in fact a very valid question, if we look across the history of investment, there has been multiple times interest rate were high by major central banks in the US or even in the other emerging markets. So looking at it in isolation, I do not think it is rate hike means a bad thing. I think that is false, because if you look at the underlying conditions now, economic growth itself has in fact rebounded quite relatively strong. And if you look at liquidity condition right now, despite the fact that we're moving into easing mode, we are still liquidity is still abundant as compared to pre-COVID level, and therefore, when we look at when it comes to assessing rate hike, we don't think it has a negative impact right now. So will it have a negative impact on fixed income? I think my short answer is no. No doubt there is some price risk, whereby if Feds are to hike rates, we will definitely see some price volatility, spread volatility, and potentially some price decline in certain segments of the fixed income markets. But overall, if you look at history, for example, you'll find that when interest rates are raised, the high-yield bonds themselves tend to do much better than your investment-grade bonds. And high-yield bonds can be an area to also look at when interest rates are hiked. So within the high-yield segment itself, there are multiple areas where it remains more susceptible to price risk coming from rate hike. So these are the segments where they tend to have a longer duration. For example, like your emerging market debt, your hard currency, as well as your local currency. And the same goes for IG bonds, where IG bonds, more segments tend to have a higher duration. Therefore, I would say they are slightly more risky. But if you are trying to invest in a rate hike environment, I would suggest also to look at the high-yield bonds, for example. Some of them really have a lower duration. And also, like I mentioned earlier, when the Fed hike rates or when the emerging markets hike rates, the economic growth itself tends to be on an uptrend. Yeah, they seldom hike rates when economic growth is decelerating, and because that itself can be catastrophic. So economic growth is already supportive, and you look at the underlying corporate conditions, it's also supportive for the issuers. So the backdrop itself tends to be already supportive for these high-yield issuers, and coupled with the fact that even if the rates are high, I still tend to believe that certain areas of the high-yield bond markets can do well, and definitely should not sell your fixed income funds.
Okay, thank you for your very comprehensive answer. So I think this leads me to my second question, because there's somebody asking also about like Asian high yield specifically. Perhaps you can share a bit more about these segments. Like, does this still warrant this investment in the portfolio despite the decline in the bond prices? And also, like, maybe another of our panelists can add in whether should we go with an active fund or like follow an ETF? So maybe Colleen, you can start.
Yeah, sure. So earlier on in my presentation, I talked briefly about Asian high-yield bonds, and it's one of our pick within the high-yield region. So looking at Asian high-yield, I think the main thing on everybody's mind is definitely China property sector. And if you look at the China property sector now, I think over the past couple of months, in fact, the last year, there have been multiple concerns, and indeed so, because some of the issuers themselves are facing a lot of difficulties. So looking ahead, does it warrant any more concerns? We think yes, but the situation is definitely getting better. Firstly, if you look at the policy direction itself in China, is going decisively easing. So that is for sure, because if you look at the central bank in China, look at government policies, they are definitely in easing mode and have done a lot of recent measures to support liquidity as well as credit condition in China. And also you look at what the government is doing right now for the property sector. They have implemented tons of measures on the credit side, as well as supporting the issuers to tide through this tough time. So policy direction is favoring the China property sector. So that is one thing. And the second thing that we note is that if you look at the yield spreads for Asian high yield, the credit spreads for Asian high yield right now, it is about 8 to 9%. So I would argue that a lot of this risk, in fact, is being priced in to credit spreads. No doubt we have dropped from about 14% to 8 to 9%, but compared to historical average, it is still about 4 to 5% above historical average. And that to me has already priced in a lot of this credit risk. So spreads are at a level where right now we are comfortable entering, and we see when we look ahead, there is potential for spread compression if the support from the Chinese government as well as the economy is there. When with spread compression, we see potential for upside. And coming from this level, there could be some significant upside looking ahead. And thirdly, if you look at the yield as well as the duration, the yield to duration ratio, also known as the Sherman ratio, it is one of the lowest, it's one of the highest amongst the different segments. So what this means is the Asia high yield bond segment is more resilient to changes in interest rate, meaning that it takes a lot more increase in rate hikes to wipe out the yield of Asian high yield because it offers such a high yield and such a low duration. So looking at those three factors, those are really positive factors for Asian high yield. And looking ahead, I think the final concern that many people have is, will Asia high yield manage the upcoming maturity for this year, which many think is quite significant. We do believe so, yes. And if you look at the macroeconomy for most of these key countries within the Asia high yield segment, China included, we are looking at the Asian economies improving this year, and policy direction still remains supportive. So all in all, we do expect the issuers to be able to handle the upcoming maturity for this year. And alongside my three previous factors, I do believe that the Asia high yield for this year will do much better than last year.
Yeah, thank you for your response. So like maybe on the second part of the question, is that whether should we go for an active management, or in times like this, we should be more concerned about the fees and go for something that's cheaper, like perhaps the ETFs. So maybe Wei Ren, you can share some thoughts on this.
Well, if you look at historically, I think iFast, FSM, we have always been believers in active management. Whenever we find that there is a good active fund that is able to outperform the market, then of course we're always very inclined to recommend investors to go for active strategies. In this case, we're talking about Asian high yield, which we all know in 2021 has undergone a significant correction. This is also a segment whereby there is a lot of uncertainties, policy uncertainties, and also credit selection is important because not all Chinese property developers are made equal. Some are stronger than others, and there are also others that are, that investors should ideally stay away from. But there are still good companies within the Chinese property market that still warrants investors' attention. And you ideally want an active manager to be there to pick up the better ones from the not so good bond issuers. You want to go for an active manager that has a robust credit selection process that will enable investors to take advantage of any upside potential in the year ahead. So I think specifically for the Asian high yield space, I think my recommendation and personal inclination is to go for active management instead of passive, even though it may be more expensive in terms of fees. But I think that additional fees that you pay, it's more than compensates for the upside potential that you could get from this particular segment.
Yes, okay, thank you for your response. So I guess overall we are still recommending an active strategy over a passive one, especially within the Asian high yield bond space, due to the extra homework that the fund managers do. And leading up to the next question, I could direct this to perhaps Hui Shi, because she covers the Asian real estate markets. So this question is asking whether like the default of all these high yield Chinese property developers, will it trigger like a systematic risk to Chinese equity as a whole?
Yeah, so in 2021, we have seen a couple of defaults across the Chinese property sector. We have China Fortune Land and liquidity crunch at Evergrande. So all of this has led to a property slowdown. And given that the property sector contributes a large share of China's economy is also facing a slowdown. And the economic slowdown is also being compounded by shortages in the energy sector, as well as the resurgence of COVID-19 cases. But here we believe that the slowdown in China's economy has reached a level that policymakers could not ignore. So in recent times, we've also seen policymakers fine-tuning the regulations on the Chinese property sector. So they have helped to speed up mortgage approvals, and also they've granted more credit to those higher quality developers. And as such, with this supportive policy fine-tuning, I believe that this will help to reduce the systematic risks to the rest of the property sector and also to the rest of China's economy. And right now, in terms of valuations, I think that most of the downside risks towards the Chinese equities has already been priced in, and so investors are likely to be able to be compensated for taking on the risk right now. And in terms of the different sectors, we are still remaining neutral on Chinese property equities, given that there are still tight regulations in place, which are likely to lead to developers storing up cash and leading to lower earnings growth. And also, the supportive policy fine-tuning is more likely to benefit China property bonds rather than China property equities. And also, investors can also consider some of the sectors within China equities that are expected to benefit from the country's long-term development plans. So this will be sectors such as Chinese semiconductors and your Chinese EVs, or even the clean energy sector. So some of these sectors are well positioned to ride on trends that are being laid out by the Chinese government.
Okay, thank you, Hui Shu, for your very comprehensive reply. So leading to the next question as well, I think there's a lot of questions asking about Chinese tech companies, especially like those names that were being bashed through the regulatory pressures last year. And also, one of the questions here asks like, what is our forecast for Hang Seng Tech, and even though like those people who have invested last year, what should they still do? Because I think currently most of the investors are looking at a double-digit losses. So what should they do like in the coming year?
Yep, I'll take this question. We actually have a segment on China Tech next week. So I don't want to steal the thunder of my colleague who will be presenting on this segment. But just to answer this question very briefly, I think the Hang Seng Tech Index, China tech stocks in general, I think that is one of our best ideas for 2022. In 2021, we have recommended this, and no doubt with the benefit of hindsight, there were several factors that blindsided, that we were blindsided by, such as the regulatory risk. But I think moving ahead, I think Hui Shi has just now mentioned also with China now shifting to a more pro-growth stance with stability as one of its main focus for 2022. Now, I think this is an important development, because when stability is a key priority for the Chinese government, that also means that coming up with drastic policy changes, coming up with drastic regulatory changes, I don't think that is something that will fit into the overall theme of stability. So we do see the worst. We think that we have already seen the worst of China's regulatory crackdown on the tech sector. We think that moving forward in 2022, there probably will be an easing of these regulatory pressures instead. So I think that's our base case for 2022, which also means that for 2022, we are actually quite upbeat and quite optimistic about the Hang Seng Tech Index. We see 2022 as a year for China tech stocks to rebound. So we think that this overall change in the government stance, that is going to be a potential catalyst for Chinese tech stocks. And their valuations are at quite low levels. I think record lows since it was first incepted. So I think from a valuations perspective, I think Chinese tech stocks, they are very attractive at this point.
Okay, thank you everyone for your answer. So there's also another question related to the China tech stock, which we do get quite often amongst clients. Is actually whether, these companies, some of them are dual listed, so they are listed in China as well as in New York. And I mean, there's a lot of headline concerns about delistings of companies from the exchanges, or like example Didi and so on. Is there any like very major concern that we should pay very particular attention to these kind of headlines?
To answer the question of whether we should stay away from the US listed Chinese tech companies. I mean, right now, what we are seeing in the asset management industry is that a lot of the fund managers, they are swapping the exposure from the US listed companies to the Hong Kong listed ones. And increasingly, we are also seeing a lot of these Chinese companies switching over to Hong Kong as their preferred listing place instead of the New York Stock Exchange. But of course, having said that, I think there is no need for you to immediately dump your US listed stock holdings just yet, because the first delisting that we could potentially see from the US is still 3 years away, because the new regulations actually states that the delisting will only take place if and only if Chinese companies, they fail to abide by certain regulatory reporting requirements for 3 consecutive years. So the first listing will actually still be 3 years away, and from now until 3 years later, a lot of things can potentially happen. And one potential thing that could happen is perhaps there could be a compromise made between the US and the Chinese government for US listings to continue. I mean, this is just pure speculation at this point, but this is something that could potentially happen. And even if 3 years later, if the delistings do take place, I think another mitigating factor is that the US listed shares are actually fungible, which means that they can be swapped into the Hong Kong listed equivalent. And with a lot of these Chinese companies maintaining dual listings in both the US and the Hong Kong, then I think from the investor perspective, I don't think we should be fearing too much and dumping all our shares at this point.
Okay, thank you. Yeah, so there's also one question about the US equity. I understand that US equity comprises largely on tech, and with the rise in the potential rise in the interest rates environment, tech might not perform as well. So, and also if you look at the valuation wise, they could be slightly overvalued at this point. I mean, due to the run out for the last 2 years. So, just wanted to share if, I mean, if you guys have any opinions to share about this segment.
Yeah, maybe I'll go first. I think addressing specifically on the topic of tech, I just wanted to say that not all tech is made equal. In a rising interest rate environment, I think there will be certain tech names that will be affected a lot more than the others. So I think the ones that will primarily be affected in a rising interest rate environment are particularly the smaller tech players, your startups, those that are still loss-making, those that are highly leveraged. So those tech companies, they will be the first ones that will be affected. And on the other hand, you also have big tech, the likes of Microsoft, Meta, and Amazon. So these are big, mature companies with a lot of financial resources. And I think in a rising interest rate environment, they do actually have opportunities to continue expanding their business. So I think this distinction between the bigger tech versus the smaller tech, I think this distinction should be made. I think in a rising rate environment, there is still the potential for the healthier, the bigger names to continue to outperform. But having said that, I think at this point, entering 2022, I must say that if you look at US tech names, big tech names in general, I think the valuations are running perhaps to the expensive side of things. A lot of expectations are being built into the share prices of these tech companies. So I think in general, US tech, probably, I don't see a lot of upside potential for US tech. And again, I reiterate my view that perhaps China tech is something that you might want to consider in this kind of environment.
Right, I will just add on to what Meiren said. So I believe the question, the first part of the question also says that if the investor view is long term, say more than 10 years, should we still venture in the US unit trust? I think if you're looking at the track record for US equity, especially the 10-year CAGR pre-COVID, is the earnings growth is growing at about 9 to 10%. So that is already higher than some of the other developed markets like US and Japan. So I think with the exposure to the secular growth trend in the US, especially from the big tech companies, there is this potential for very strong long-term earnings growth ability as demonstrated over the past 10 years. And I do think that if an investor's horizon is more than 10 years, there is still definitely room for the investors to venture into US equity because of a very, very strong earnings power, especially proven earnings power over a longer term period. And if you look across the different markets, right now it is hard to get into a market where the market provides such a growthy trend as well as the exposure to such long-term, very strong secular trend. So I think US is a good example. And with that said, I think we still have to bear in mind with the current level of valuation, as well as in which area the investors want to enter into the US equity market. So I think taking all that into consideration, I will still say yes, shouldn't, because if you have a long horizon, you still should venture to the US despite all these near-term issues, but keep aware of the current valuation level, especially as a market and as the different sectors and industries.
Okay, thank you for answering all the questions. So maybe just a very last question to wrap up today's session because we are running a bit out of time. So could you just share with us like one key takeaway among all the events that we have today? Like what can our investor take away that one thing? Yeah, I'll start with Weiren first.
I think for me the takeaway is really diversification. We have seen in 2021 the emergence of Delta and more recently Omicron. I think our battle with the pandemic is not over yet, and that also means volatility is likely going to be high. Uncertainty is going to be high in the markets as we move into 2022. So the only way for us to navigate this kind of environment is to really have a diversified portfolio to weather through all these uncertainties.
And for you, Hui Shi?
I think one of the key themes that we have shared throughout this entire program today, as well as one of the major themes in 2022, I think that would be rate hikes. And in terms of equities, one potential sector that investors should be looking into in 2022 will be the financial sector, in particular the banks, as they will benefit from the rate hikes in terms of their net interest margins. And most of the banks, especially those in Asia, they derive a lot of their revenue from their net interest income. So rate hikes will definitely be a significant development for the banks in 2022.
Yeah. And last of all, Colleen.
Right, I would just say that looking at the title, the show must go on. I think the show will go on. You look at markets will go up, markets will come down. So no matter what you decide to buy, be it a company, an issuer, or a market, do know what you're buying into. So for example, you look at the company, do know what you're buying into, what the company is about. Are you comfortable buying into that company? If you look at the market, do know the basic stuff is of the market. So what the growth trend is like, are you comfortable buying into it? So knowing what you're going to buy into, I think that really helps and alleviates a lot of unnecessary concern, as well as emotional fears, as well as all this different distortion.
Thank you so much for all of your insights. So I hope all of you learned something from this Q&A, and do stay tuned for the quiz section. And now I'll just pass back the time to Gladys.
Thank you, panelists, for answering our questions today. Before we head into our quiz segment, I'd like to share with you some of the promotions available at fsm1.com. Firstly, receive 3,000 rewards points by opening a new FSM1 account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is WAWTI2022. From now till December as well. Secondly, FSM1.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Finally, check out this limited time promotion, Power to the Portfolio. From 8th of January 2022 to 31st of January 2022, receive $10 bonus units for every $10,000 invested in 17 unit trusts, spanning across 10 different markets, sectors, and themes that you can consider incorporating into your portfolio in 2022. You can also enjoy 3 free trades into selected ETFs covered during What and Where to Invest 2022. Of course, terms and conditions apply. You can refer to the fsm1.com homepage to browse the list of funds and ETFs on promotion. Now, let's begin our quiz for today. To access the quiz, you'll need to be on Event Live. Click on Agenda and Activities on the left-hand side menu. Under the Agenda section, click on Quiz. Click on the Join Quiz button. The activity window will be displayed on the right. After each question, the leaderboard will be displayed, and once the quiz ends, you may check if you are one of the final winners. 6 winners with the correct answers will each win $100 worth of FSM1 cash account credits, sponsored by our platinum sponsors CSOP Asset Management, East Spring Investments, and Nickel Asset Management. Note that your results will be based on the accuracy as well as the speed of your answers. If you're ready, let's begin with a trial question to get us warmed up. 3, 2, 1. Warm-up question number 1. What does FSM in FSM1 stand for? Is it Fund Smart? Or is it Funds Market? Or could it be Fund Supermart? Or Fund Supermarket? What does FSM in FSM1 stand for? Remember, your results are based on the accuracy as well as the speed of your answer. And the results are out. It seems that most of you are aware of the correct answer. 91% of you got Fund Supermart. The correct answer is indicated by the green tick on the right-hand side of your screen. 9% chose Fund Supermarket. I see you were quite close to the correct answer. Now, this is just a warm-up question. We'll be moving to the actual questions very shortly, so get your fingers ready. The leaderboard will also show up for the actual ones and not for this warm-up question. In 3, 2, 1. Question number 1. Which of the following statements is true? FSM1 believes equities will outperform fixed income in 2022. Or is it the second statement? FSM1 believes the Hang Seng Index will rise to 34,000 points by end 2023. Or is it that FSM1 is most bullish on these 3 sectors in China: utilities, industrials, and consumer discretionary? Which of the following statements is true? And look at that! Over half of you have got the statement correct. It is the first statement. FSM1 believes equities will outperform fixed income in 2022. It seems that 28.7% believed in the second statement that Hang Seng Index will rise. But look at that, we have our results out already. We will only have 6 winners, mainly the first rank 1 to rank 6, but you all have a chance to rise up the ranks. So buckle up and get ready. This is our leaderboard. Let's move on to the second question. Which of the following statement about the Nickel AM Singapore Dividend Equity Fund is false? The fund is available for investing via cash, SRS, and RSP. DBS and CapitaLand can be found within the fund's top 5 holdings. The fund does not take a balanced approach of capital appreciation and dividend yielding income. Quite a lot of words out here, could be a little tricky. Which is the false statement? Remember, you have to be fast. And let's see, 21% chose the first statement that it's available via cash, SRS, and RSP. 11.3% chose the second statement, but it seems that the majority of you have got this question right. Yet again, 66.96% chose the last statement. Alright, congratulations. We've got Chiho, IGS, Bani Manto, Chongchen, Julie, and JHI. It seems that our top 6 ranks have pretty much kept their positions. Let's see if our next 4 ranks will be able to catch up. Good luck to all of you. Let's move on to question number 3. Which of the following markets have underperformed in 2021? Is it Thailand, Malaysia, Indonesia, or Singapore? This is a pretty important one. Which of the following markets have underperformed in 2021? Note, if your result screen shows you between rank 1 and 6 at the final leaderboard, make sure to take a screenshot showing the whole activity window, including your rank, score, and nickname. Alright, this is question number 3. Just a few more questions to go. It seems that the majority of you have got it right yet again. 70.59% chose Malaysia, with only 4% choosing Indonesia, Singapore, and Thailand. Congratulations to all 70.59% of you out there. We'll be moving on to the leaderboard, and then question number 4 very shortly. Wow, it seems that some of the names have jumped. Now it's Chiho, IGS, Chongqing, Bunny Mantou, Julie, and JH Chia. Let's see if our rank 7 to 10 managed to switch. How did you guys fare? I see some new names. Congratulations once again. Let's move on to question number 4. Which of the following is not a reason why India should be on investors' radars? Which of the following is not a reason? Positive secular trends in the capital markets? India, like China, is evolving into a strong Asian economic giant? Or is it the third statement? India equity market has high correlation with US equity market. Which of the following is not a reason? Once again, you have to be quick, but you have to be accurate. Which is not a reason why India should be on investors' radar? Wow, impressive. 85.12% of you got it right. Yes, it is the last statement. India equity market has high correlation with US equity market. Only a small percentage of you chose the first and the second statement, so good luck. We've got one more question to go. Let's check out our leaderboard. Well, I see the names have pretty much maintained. Come on, you can do it. Rank 1 to 6, we still have Chiho, IGS, Julie, Bunny, JH Chia, and Chongqing. Let's see if the ranks will change for our final question. Which of the following is not an investment theme in the US that have emerged coming out of the pandemic? Firstly, financials. Secondly, real estate. Third, healthcare innovation. And fourth, consumer spending patterns. Which is not an investment theme in the US that emerged out of the pandemic? Once again, we'll show you the leaderboard very quickly, so make sure to take a screenshot for our rank 1 to 6. Alright, make sure that the entire activity window is captured and it shows your rank, score, and nickname. And impressive! The majority of you got it right again. The correct answer is real estate. Alright, and coming up in second place in the voting, it was consumer spending patterns, but real estate is the correct answer. And this is our final question. Congratulations to all 6 of you rankers: IGS 1 to 3, Chiho, Julie, JH Chia, Chongqing, and Bunny Mantou. To our rank 7 to 10s, congratulations. It was a great try and you were so close, but don't worry, we've got more to come. And to the rest of you, thank you for taking part. To our winners, make sure you email the screenshot, alright, of the leaderboard. Make sure you have the whole activity window. Email the screenshot, including your name, FSM account number, and the daily quiz date to events@funsupermart.com. Once again, the email is events with an S at funsupermart.com by 31st of January to claim your prize. Alright, and this wraps up day 1 of What and Where to Invest 2022. But of course, the show must go on. So please join us again next week on the 15th of January, 10 a.m. for another lineup of insightful presentations, as well as another chance to join the daily quiz and our lucky draw. You can check out what is ahead as well by visiting whatandwhere.fsm1.com and clicking on the program tab. Thank you and see you next week.
internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease.
Hi guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.